Okay, good morning. We're going to do something unusual this time. We have a chock-full program, so we're going to actually start on time. So good morning and welcome to the summer 2024 UCLA Anderson Forecast Conference. Our conference is joint this summer, as it is each summer, with the Ziman Institute for Real Estate. We always enjoy partnering with them. And we have a big program coming up. We're going to begin with the US and California forecast. I'll be talking about that. And then we're going to turn it over to David Schulman. David's back with us. Many of you know David. David is a Bruin graduate. He received his PhD here at Anderson, had a distinguished career teaching at UC Riverside, a distinguished career on Wall Street, came back to the Anderson Forecast and thought he was retiring, but we don't allow that here at the Anderson Forecast. So he is back with us. He's going to talk about finance and the landscape for residential real estate. That's going to be followed by a presentation on some new research we're doing by one of our new economists, Sayantani. Sayantani came to us from our sister institution at UC Irvine and is joint with the, her appointment is joint with the Ziman Institute. And she works on real estate and has some new research. And this is really preliminary research, but we want to expose you to some of the exciting things that we're doing. And it's on trying to really drill down on construction costs and to do an objective, independent construction cost forecast. Of course, everyone who's involved in development does a construction cost forecast for their own business purposes. We wanted to provide a disinterested forecast as a way of providing sanity checks for that. And as she'll tell you, the university system actually requested this. And then after that, we're going to have a partner from Alan Matkins talk about the Alan Matkins UCLA Anderson Forecast survey. This is a commercial real estate survey over 8 markets and 4 commercial real estate types that we do twice a year. We just finished it. You're going to see some preliminary results, and the brochure, which we jointly published with Alan Matkins, will be out in a month's time. So it's a bit of a teaser, but there's some really interesting results. I think you'll enjoy that. And then we're going to take a short break. And we have our keynote, David Benson, who just a week ago or 2 weeks ago, it's been a month already, wow, retired as president of Fannie Mae. So David is our keynote, and then Stuart Gabriel, the faculty director of the Ziman Institute for Real Estate, and also a finance faculty member here at Anderson, will be leading a really interesting panel on residential real estate. So a big program. The other introductions I want to make, well, first of all, I didn't introduce myself. I think most of you know me, but maybe not everyone. So I'm Jerry Nicholsberg. I'm the faculty director of the UCLA Anderson Forecast. We also have with us some new members of the forecast, relatively new members of the forecast. Thomas Ash joined us from USC. Thomas works on finance and the environment, and you'll be hearing about his research in our it's October conference. And Ji-Yoon Lee joined us as our environmental climate change economist. She'll also be speaking at the upcoming conference. She joined us from Cornell. And kind of finally, we have a new economist joining us this summer, Clement Bohr, who comes to us from Northwestern, and he's going to be leading our US forecast team. So he'll be doing the US forecast in October rather than myself, but I'm going to do the one today. So that's our program for today and our forecast team. I would be remiss if I didn't thank Seth Katz, George Lee, and Virginia Dela Cruz Gatau, our staff members. the whole reason this thing works is because of all of the extra hours they put in to make it happen, and we're most appreciative of their contributions. Finally, before we get to what's happening in the economy, we're a public institution, as you know, and we could not put these programs on without the generous support of our sponsors. And so I do want to thank them and recognize them. Our principal sponsors today are RSM and Yamava Resort and Casino at San Manuel. Our platinum sponsors, the law firm of Allen Matkins, California Bank and Trust, Cathay Bank, Clark Construction, Leap Development, and University Credit Union. At the gold level, Avenue Insights and Analytics, California Steel Industries, Hub International, PNC Bank, Robert Half, and United Airlines. At the silver level, Bank of California, Chevron, Commercia Wealth Management, JLL, Marsh McClellan Agency, MBK Real Estate Companies, SMBC Manu Bank, U.S. Bank Wealth Private Management, Wilmington Trust, Hanmi Bank at the bronze level, HDR, McCarthy Cook, PCL Construction, Shawmont Design and Construction, Shopoff Realty Investments, and at the Bruin level, Advisors Real Estate Asset Services, Gerber Kawasaki Wealth and Investment Management, and Shell Energy. Many thanks to them. I do want to point out, if your company is not, if you didn't hear your company's name, let us know, because we can fix that. But we are most appreciative of our sponsors. So with that, let's turn to what's happening in the economy. And I'm going to lead this off by talking about the U.S. and California. And what I want to focus on today is unemployment. The U.S. unemployment rate is elevated. It's gone from 3.5 to 3.9%. The California unemployment rate is elevated also, but it's way up at 5.3%. What's going on there, and how does that inform the forecast? So I have one image here that those of you who are up to date on popular culture recognize. That's the unemployment office in Quahog from Family Guy. On the right-hand side is an image I do want to leave you with. Anyone who does a forecast today has to make an assumption about what's going to happen with U.S. economic policy in 2025 and 2026. And obviously, we have an election this year, and it could be very different from what it is today. Our assumption, and we want to make this explicit, is what you see in the picture here. It's been gridlock. We're assuming it's going to stay gridlock. If it doesn't, if one party or the other wins both the Congress and the White House, we could have different economic policy. And that means that the forecast that we're going to talk about today could be off because of that policy. We're going to say a few things about that, but not a lot. So let's move right into it. We're going to talk about the macro outlook, and then interest-sensitive sectors and other sectors that give us that macro outlook, and then the California forecast. So we're going to jump right in with the macro outlook and start with the unemployment rate. It's at 3.9%. Now, this scale is accentuated so you can see the increase, but it's actually not that many percentage points. But you see this big dip here on the left-hand side. That's about 3.5%. And then you see it coming up. That vertical line separates actuals from forecast. And April, which is not an actual, even though it's in red there, that's the April unemployment rate. The line traces out the quarterly averages. And the question we want to ask is this indicative of something going wrong with the economy, or is it just normalization? Is that area inside that red circle the abnormal? And you know, where we're at 3.9 to 4.1%, is that the normal, or is that the abnormal? Because that's going to make a difference. So there are really two ways that you can get that you can get this elevated unemployment rate. One is you can have weakness in the economy and you can have layoffs. The other is that you can have constraints on the economy, so you can't grow quite as fast as the labor force, and you get kind of a normalization. Now, there's a level of unemployment that a well-functioning labor market needs to have. This is people changing jobs and looking for new jobs. That's new entrants coming in, looking for new jobs. It's what economists call the natural rate of unemployment. But of course, we don't know exactly what the natural rate of unemployment is, so we have to infer this. One more comment about the unemployment rate. It really is a notional piece of data. It is not an objective piece of data. What do I mean by that? The way in which we get the unemployment rate is the Bureau of Labor Statistics calls up households and says, are you employed? If the answer is yes, you go into the labor force. If the answer is no, they say, are you looking for a job? Have you looked for a job? If the answer is yes, you also go into the labor force, and the unemployment rate is the ratio of those who said yes to the second question to the total labor force. There are lots of reasons why people will say that they look for a job or that they didn't look for a job, and it's not accurate. So what we really want to do is kind of infer what's going on from other data. So let's first look at this unemployment rate that we have now and compare it to the historical data. If you look over on the right-hand side, what you see is a little bit of a rise, but compared to historical rises in unemployment, it's pretty small. And if you were to draw a horizontal line from the right-hand side all the way over, you have to go back to the 1960s till you get unemployment rates that look like what we have today. So this doesn't look unusual where we're going in the lower 4%. Another way to think about this is layoff rates. If the economy is weakening, you expect to see the layoff rate increase. And one measure that we have of that is in this graph. This is the new claims for unemployment, monthly average, new claims for unemployment, divided by the total payroll jobs, so the people who would qualify for unemployment. And again, look all the way over on the right-hand side, historically low layoff rates, and they're not going up. So that suggests that we've got normalization and that we were at an abnormal period. Well, let's look at one other piece of data here, and this is the duration of unemployment. And the graph on the right-hand side, the top two lines are short-term unemployment, and the bottom two long-term unemployment. And we see they're kind of moving around a little bit, but not no dramatic change. And then the table on the left-hand side, what you see is April's percentage of the unemployed who are short-term, 35.5% less than 5 weeks, 31.2% between 6 weeks and 14 weeks. And those numbers compared to the last 3 expansions look really normal. So we don't really see any evidence that the unemployment rate, even though it's increasing, is increasing to an unusual level. Rather, it suggests that that area that was in that red circle was an overheated economy. And we saw some articles about that very tight labor markets, increased immigration, and higher wages bringing prime working age adults into the labor market have eased that, and we're sort of at a more normal labor market. So that brings us to our forecast. This is GDP growth rates, and what you see here to the left is that we had an above trend 2023. Our the first quarter of this year, 1.3% growth, and a lot of that was inventory adjustment. Inventories are now up, but we are seeing not the same kind of robust growth that we saw, for example, in the third quarter of 2023. So we're looking at this quarter and the next 2 quarters as really a 2% economy. Okay? And 2 reasons. One is we still have labor market constraints. The second is we have capacity constraints also. And we're going to look at some data to illustrate that. Then we go back to slightly above trend growth as those capacity constraints ease in 2025 and 2026. And we've also built in, due to new technologies, an increase in productivity. And that gives us a little above the 2.5% growth rate. The 2.5% growth rate, which is sort of our historical average over the last couple of decades. Okay, so that leads us to inflation and what is the Fed going to do, right? So pretty good growth, but sub-trend, then above trend. If we look at the inflation rates, and that's what you see in this diagram, the headline inflation, this is a CPI, is in black there, and then it turns to red when it gets into the forecast. And then in kind of an ochre color, you see core inflation, which takes out the more volatile energy and food. And again, these are quarterly averages, but the April numbers are there, and you see 3.4 and 3.6%. So inflation rates really above the Fed's 2% target. And we have it coming down slowly, and we're still in the, now I thought I had that there. And by the end, we're still in the mid twos on the CPI. When you look behind these numbers to say what is holding the inflation rate up as measured by the consumer price index, you find that it's almost all in rents, right? And the way in which we contract for shelter in the US, rental shelter. So your mortgage is not in here if you have a mortgage. This is rents. And we do long-term leases, but even when our leases expire, if we're a good tenant and we're staying in the unit that we're renting, we get a small but not a to-market increase. And if we're in rent stabilized units, we get an even smaller increase, if any. And it's when those units free up, which happens over time, that those units are marked to market. And since we had this big run up in rents in the last couple of years, they're not going up now, but since we had this big run up, it's going to take years for that to just work through the numbers. And higher interest rates is not going to affect that. And so that's what's going on here. And then one other comment, the Fed looks at something called the Personal Consumption Expenditure Price Index, which is highly correlated with the CPI, but it is in the upper twos now. So it's considerably lower than this. So that leads us to say that, well, the Fed is not going to raise rates, even though it's not at a 2%, but in the third quarter of this year, and we put this in November, the Fed is going to start lowering rates, and over 4 FOMC meetings, they're going to lower rates by 100 basis points. So why would they do that with the inflation rate not at 2% and with full employment? And the answer is that as that inflation rate comes down, albeit slowly, the real interest rate, the inflation adjusted interest rate, is going up by about 100 basis points. And to keep from having tighter monetary policy, sort of taking a neutral stance, we have them reducing the federal funds rate. What that does is by the fourth quarter of this year, markets now understand that future short-term rates are going to be lower and are moving lower. And after a 2-year inversion of the yield curve, we're going to get it turning right side up, but it's still going to be very flat for a while. So that is our interest rate forecast. And you see there the 10-year and the 3-year. If I had put the 2-year on there, it would look the same. So that leads us to interest-sensitive sectors. And so these are the ones that those higher interest rates should be affecting. And we should note that we have higher interest rates now, and we talk about interest rates are really high. Actually, interest rates are really normal. They were just abnormally low. So let's take a look at housing. Our colleague, Ed Leamer, wrote a paper called Housing is the Business Cycle, because 7 of the post-World War II recessions were characterized by higher interest rates and a sharp downturn in home production. And what you see here is new building permits for the US. And over on the left-hand side, where we had 4% average 30-year fixed mortgage rates, in the US, new home construction was about 1.3 million, way below our historical average. And we've been underbuilding housing for a long time. Then we have a pandemic surge where we found that sitting on our beds with a laptop open wasn't really satisfactory in any way we could move to the mountains or someplace nice because we were working remote, a real demand for housing and a surge in building that housing. And that's that pandemic surge. But now we're past that. And what we see is that builders are now building slightly above the historical average at around 1.5 million. Now, what you see at the end here is a downturn. If you look behind the numbers, you find that that downturn is where there were adverse weather events. And so we are expecting this to come back. You're going to hear a lot more about housing later. But in our forecast, what we have is that housing is not tanking, but it's not growing rapidly either. So this is kind of a constraint. And one of the constraints is simply the construction labor to build new housing. And that's certainly a factor here in California. So we stay about 1.5 million going forward. If we look at some of the other interest sensitive sectors, for example, autos, we underbuilt autos and the auto manufacturers are struggling to keep up with demand. Except in electric vehicles, but in the import numbers for April, one of the leading categories of imports was automobiles. So still robust demand for autos. Our cars are wearing out and we're buying new autos, or we're trying to buy new autos. So that is not really responding in a negative way to the interest rates. An important sector is investment. And the chart you see here is durable goods. It takes out defense goods, because they're not interest sensitive. And it takes out aircraft because you have a lot of volatility in terms of when aircraft orders are made. Boeing hasn't had many for a while. Wait till the end of the month at Farnborough. You're going to see some big orders for Boeing. That would just cause a lot of volatility in these numbers. And what you see is it comes up and to record levels, is still increasing, but increasing at a slower rate. And part of the reason why it's increasing at a slower rate is that manufacturers' backlogs are building up. They can't get deliveries, they can't manufacture and deliver rapidly enough. And so that's part of the slowdown that we see here. One consequence of that, in addition to the CHIPS Act and in addition to the Inflation Reduction Act, is new factories being built kind of all over the country. And that is going to ease these capacity constraints. And it's not just the CHIPS Act and the Inflation Reduction Act. There was just announced that a new large steel mill this is going to surprise you, is being built in Kern County in the city of Mojave, right? So manufacturing is definitely coming back to the US. That's going to affect 25 and 26, not 24. It takes a while to build a factory. So let's turn to some other sectors. And what you see here is consumption. That's 2/3 of GDP demand. Defense, remember we excluded that from the durable goods orders. And then there's a picture of what we in California don't like to talk about, which is oil production. That's from Oxnard. And we'll talk about energy. So first, consumption, we're above trend. If you kind of squint your eyes, you can see student loan, you can see consumer debt, you can see the end of the stimulus payments. It doesn't affect consumption very much. We're above trend. Our preferences have changed. We're much more willing to spend now and enjoy life today than to save for the future. Savings rates are low. As we get further away from the pandemic, and this is what you see in the historical data, we expect savings rates to start inching up. And that we have in 2025 and 2026. That's going to offset some of this increased demand that we see elsewhere. And here's one of the places we see increased demand, which is in defense durable goods purchases, a more dangerous world. Even though we have gridlock in Washington, we have defense goods going up, and our foreign allies are also ordering more defense goods. And just as a kind of an aside, this only affects a few states. It affects California, particularly this part of California, Texas, Georgia, Connecticut, a little bit in Arizona and in Washington, and not much else. So that's going to be disproportionately beneficial for California. You hate to see wars. be beneficial. But the fact is that we do have wars around the world, and that is going to impact in terms of more demand for manufacturing in California. And then finally, for the U.S., oil production and oil prices, and oil production is that blue line at the top. You see a dip there. That dip was in the Permian Basin due to weather events. We're expecting that to come back, but you also need more oil drilling rigs in order to get much more expansion in production. But markets are saying that that prices, which is represented by the orange line, that's West Texas Intermediate, that prices are going to come down, that there's ample supply. And again, this is monthly average, and you see it's above 80. Now, West Texas Intermediate, as of this morning, might have changed since we started the conference, was under 75, right? So high oil prices or increasing oil prices are not going to be a negative for economic growth going forward. It doesn't really look like we have an issue there. So U.S. outlook summary: employment and income remain strong. Investment and consumption are going to continue to drive economic growth. We've had these interest rate increases. They clearly cooled the economy, but cooled it from being really a hot economy, an overheated economy, to one that's a bit more normal. And we saw that in the unemployment rate normalizing. And we have infrastructure, the infrastructure bill, industrial policy, and defense demand just added to a full employment economy. We do have, do need to say, because everyone asks about a recession is coming eventually. It always does, but it's not in the near-term data. But we do have risks, which could really move us off of this forecast. And we have conflicts in the Middle East and Russia and Ukraine. Those conflicts seem to be contained as far as their impact on the world economy. That's not necessarily going to be the future. So we need to keep our eye on that. We have election worries. The two parties have very different economic policies. And in our forecast, we have ramped back investment in the third and fourth quarter of this year as businesses wait to see the outcome of the election before they make decisions about what they're going to invest in and how much. And we have the possibility of supply chain interruptions. If you look at the manufacturing centers of Asia, none of them are on high ground. They're on river plains. They're on, in Shanghai, for example, half of Shanghai is an area called Pudong. And when I worked in China in the mid-90s, that was just a mud flat. It maybe got a foot or two above sea level. This is characteristic of all the Asian manufacturing centers, and climatological events could really create supply chain interruptions, and that would throw us off our forecast. Okay, so now turning to California and staying with unemployment. This is a graphic from the Department of Finance, California Department of Finance's website. They didn't overlay them one to another. But the reason why I'm showing you this is if you look on the right-hand side, you see the US 3.9%, California at 5.3% and 1.4% differential. No, 1.4 percentage point differential. Look all the way over on the left-hand side, that's 1975, and the numbers are different, but the differential is the same. Was that intentional? I don't know. But what we want to do is ask kind of how unusual is this for California? And what does it mean for California? So to do that, let's look at the two measures of employment. And the top line, the blue line, is where we get our unemployment numbers from. It's a survey called the Household Survey. That's the one where they call up people and ask, are you employed? Are you unemployed? And they track kind of pretty much together. But what you notice is that the red line, which comes from a much larger survey and is considered much more reliable, because the household survey is only of 5,500 households in our 40 million population economy. So it's a small sample. But the red line comes from regulatory reporting of firms for purposes of payroll taxes. And it's a sample as well. And if you look at the red line, so payroll jobs is just under 2% above the previous peak. If you look at the blue line, it doesn't get to the previous peak. But one thing to notice that's going to be important here is when that blue line flattens out, you notice there are two dips in it. And those dips correspond to the 2022-2023 winter and the 2023-2024 winter. So let's talk about first what's in each of these and not in the other. So first in the payroll, that's the red line, remote workers who are working out of state. So if your job is in Los Angeles, but you're remote and you live in Phoenix, you're in the red line because your enterprise is in Los Angeles, but you're not in the California labor force. You're in the Arizona labor force because that blue line is where you live and the red line is where you work. So remote workers are not in here. The other that's not in here are undocumented workers who have fake documents, right? So they're reported for regulatory purposes as being payroll employees. But if you call them up and say, are you working? No, I'm not even here. You're not talking to me. So they're not in the blue, right? What's in the blue but not in the red? And this is maybe more important. Farm workers. Family members working in family businesses. So if a family has a restaurant and two teenagers are working there, they're in the blue. If that restaurant goes out of business, they drop out of the blue. They were never in the payroll survey. And importantly, in today's economy, gig workers and independent contractors, right? So there's some real important differences, and let's dig into this. Unfortunately, except for farm workers, that blue line, the household survey, doesn't tell us what industries people are in. So we're going to have to infer this from the enterprise survey, the red line. First thing we want to do is say, how unusual is the 1.4 differential, and what can we learn from that? And if you look at this, the blue here is California, the red is the US. You see sometimes there's really big differences, over 2 percentage points, not 1.4. But there are four persistent periods of greater than 1.4 percentage point differences between the US and California. The first two are the end of the Vietnam War and the end of the Cold War. And that was because California, you remember I said California is going to benefit in terms of increased demand for defense durable goods? Well, when we stop ordering them, it is disproportionately hurt by that. And that's those two. And the one in the 1990s was a very long drawn out period because we had a high concentration of engineers here in Southern California and kind of nowhere for them to go for a while. And then we have the speculative housing bust, which was more acute in California. And then finally COVID, in which we had a more strenuous lockdown than most other parts of the country. So those are very specific California things that have happened. So that's what we want to look at is what are these specific California things? And when we just think about it, there's not much. So it must be spread kind of evenly or widespread. And you can see that in the decline in employment by sector in California in this graph. This is the first 4 months of the year. And we've got construction, we have farm, durable goods, education, finance, pretty widespread. And so we're going to want to look at that and say, well, what are the prospects of that for 2024 and beyond? And if you take these sectors, these are sort of large sectors, but if you break it down and look at some of the subsectors, the two with the arrows there are farm and food processing. Of course, if you're not producing food, then you're not processing it. And anyone who's driven on the 5 through the Central Valley and observed Tulare Lake, they're not producing food in Tulare Lake. And they were, right? So we have a cutback there. And then we have Hollywood. So we want to look at that. Real estate, that's in finance. And we want to look at what's going on there. And then warehousing and couriers, those are two subsectors of logistics. So let's jump in with manufacturing. You saw that in 2 slides ago, durable goods manufacturing. And this is what's happening. We have a 28% increase in output. We're having a churn in manufacturing. The new factories in California are semiconductors, electric vehicle chargers, sophisticated aircraft like the B-21, the new steel mill. Those are going to open up in 25, 26, and 27. So even though we have a downturn in durable goods manufacturing so far this year, as we go out into the forecast, we're expecting growth here. So that's not a longer-term problematic sector. The next one is logistics, and we saw 2 in logistics. I want to focus first on warehousing. And this is traffic through our ports. The bottom line, the red line, is exports. And some of that is food, it's agricultural products. But a lot of that is simply because no matter what we think about the US economy, we're doing so much better than everywhere else. And as Japan starts growing, as China starts demanding more, we're going to see more exports. Not a lot, but we have more exports in 25 and 26 in our forecast. And the top line is imports. And for imports, you see this big bulge. That's when we were at home and when some people like myself were on Zoom, but really on Amazon and buying goods. And that dip there is when the ports just became locked up because they couldn't get containers off of the port facility. Then we have 2 things happen. One is we cut back on our goods purchases because now we can go out and buy services. And the second is we had 2 threatened strikes, one by railroads and the other by longshore workers. And so trans-Pacific shippers were diverting at least some of their shipments through the Panama Canal to East Coast ports. And now we're seeing that coming back. And our expectation is that that's going to come back to greater than where it was before. Not greater than the pandemic surge, but greater than 2019. And so we'll get growth in warehousing. And the reasons are threefold. This is one of them. That looks like when you could walk from Long Beach to Catalina, when the ports were locked up, but just by jumping ship to ship. That's the Panama Canal. The Panama Canal relies on a large freshwater inland lake that is at low water level due to a drought, and you can get many fewer ships through. Some of these ships cost you $1 million a day to keep on the water. And so we're seeing that coming back. The second is they also have dock workers in the East Coast. And it's time for them to negotiate and threaten a strike. So we're seeing that diversion coming back. And the third reason is the unfortunate attacks, or the tragic attacks, if you will, by the Houthis in the Horn of Africa, diverting seagoing trade away from the Suez Canal. And for at least some of that, coming across the Pacific and unloading here and shipping by rail back east makes more sense. And so these 3 things are going to, as we move in the next 3 years, add to demand for warehouse. In terms of tech, we had this big bulge as companies were trying to build out platforms for virtual meetings and virtual conferences like this. And then we have a cutback by the big tech firms, but we don't have a real implosion going on. It's leveled out. Those tech workers who are now showing up in the unemployment statistics, as they get soaked up, they're going to, then the tech firms are going to be hiring again. So we're not really concerned about that, particularly because AI research and development is centered in California. And I just want to show you, what's happening with large venture capital investments in the first quarter of this year. And the first quarter of this year was not a big year, not a big quarter for venture capital. But here are the top 10 that comes from KPMG's Venture Pulse Venture Pulse report. And just to go through these kind of quickly of where they are, number one, San Francisco AI, then there's one in Massachusetts, then Silicon Valley, you get one in the Research Triangle of North Carolina, San Diego Biotech, Silicon Valley AI, Silicon Valley Automotive, one in Colorado, and then two more in San Francisco. The venture money is coming here. AI, there's been a sort of a cutback in venture money for AI, but not from big company investment like Microsoft and Tesla in AI. So our expectation is that tech is not going to be a drag on the California economy in 25 and 26. Turning now to housing, and what you see, we're going to start with the top diagram there. And you see a big drop in home sales to depression levels. That affects mortgage brokers. That affects real estate brokers. That's that finance piece. And until that comes back, there's going to be unemployment there, or those folks are going to be moving into other activities outside of finance. If you move down to the right-hand side, California home prices are at record levels. There's a lot of latent demand. And then continuing on clockwise, you get to permits. And you notice permits haven't really been growing. They're sort of down. But look at that pattern. That's winter of this year. There's another one that looks like it as you move your eyes from right to left, winter of last year. These are climatological events. We expect that to come back. We don't expect home production in California to exceed last year, this year, but then growth. And in fact, the census came out. This is going to be a surprise to all of us. It was a surprise to me. The census just came out with home production by cities in the US from the summer of 2022 to the summer of 2023. No surprise here, Houston and Phoenix were the top two. The surprise is number three, Los Angeles. So the latent demand seems to be here, but we're not there yet. And part of the reason is construction. So now turning to Hollywood, and I showed you this last time when we were talking about the writer's strike. The top line here is television production, days of filming from Film LA. Bottom line is feature films. And you see it dropped in anticipation of the strike. Usually it goes up in anticipation of the strike in stockpiling, and it's not really coming back. And this is through the first quarter of this year. Hollywood was producing too much content. And importantly, thinking about the blue line versus the red line, a significant part, and it's been estimated as 2/3 of workers in Hollywood are independent contractors, which means they would be in the blue and not in the red. That's not coming back. So that's a problem area. They're going to have to find work in other sectors. And, you know, this is just an article from the LA Times recognizing as Hollywood crews in crisis, everyone just in panic mode as jobs decline. And as I say, that's not coming back. So finally, you remember education was there. Look at the upper left-hand side. That's K-12 enrollment in California schools is down due to fertility and due to smaller household sizes, and it's not coming back. So again, this is one of the problem sectors where people are going to have to find jobs elsewhere. And then finally, we had a lot more delivery workers, couriers. Remember, the couriers was one of the big blocks. A lot more in the way of couriers in the pandemic and its aftermath than we really need today. And so, for example, UPS nationwide is laying off 12,000. Now, a lot of couriers are also in that blue line and not in the red line because they're independent contractors. The California specific part of this is the increase in minimum wage for limited service restaurants, chain restaurants. And that's the bottom picture here. So Pizza Hut has announced the layoff of 2,000 delivery workers in response to that. Again, that's not coming back. So we have three not very large, but important sectors where we don't see a return of previous employment. But most of what's giving us that higher unemployment rate we do see a return in 25 and 26, which brings us to the summary: manufacturing, logistics, in particular warehousing, and tech recovering, construction, real estate, and ag a bit more slowly. Hollywood, education, and couriers, not really at all. So that gives us a 2024 atypical for California, growing slower than the US, and 2025 and 2026 growing more rapidly as these sectors recover. The usual risk to the forecast: housing and homelessness, urban public safety, climate change, and importantly, if in 2025 we get, as a matter of US policy, a shutdown of China trade, that'll have a negative impact. Some of the politicians running for office are saying we should do this. But if that happens, look, also, I said recession is coming. Add to that soon. And just to finish with some numbers, we're expecting a normalization going back to the kinds of growth rates we experienced in 2019 by 2026, but not much in the way of housing growth this year. And that brings me to the end of the US and California. Thank you. And now let me turn the microphone over to David Schulman, who's going to tell us about what's going on in finance and housing. David.
Good morning. I have a few main themes to discuss today. Number one, and most importantly for housing, is the era of very low interest rates is over. Full stop. Housing starts are doing remarkably well, given the interest rate environment, which has surprised lots of people. That's not true for existing home sales, and I'll explain why. The boom in multifamily construction is over and will remain over for the next couple of years. The consumer price index will continue to lag market rents. And what happens? So the consumer price index will hang high, even though market rents are weakening. The affordability crunch will get worse. And some new issues are going to be capital gains taxes on high-end housing, which most people aren't focusing in on, but will become a big deal, especially in high-cost housing areas like here, and I'll give you some numbers. And the other thing is how home insurance costs, both the price and availability of home insurance will be a real blockage to the system. First here, this is the history of mortgage rates going back to 1972. I remember 11% mortgage on my house. I remember 9%. I remember 11%. I remember 6%. I also remember 2.5%. I also remember 2.5%. And you take a look at where we dropped when mortgage rates got as low and got below 3%. Now they're around 7 or 6 3/4 right now. My guess, it is very unlikely that mortgage rates will go meaningfully below 6% over the remaining decade. So I don't think we're going to see them go below 6. It could be 5 3/4, but I don't think it'll be meaningfully below 6. So I think my view on interest rates is somewhat higher than Jerry's. And you take a look at this long downtrend in rates, which began in 1981, continued irregularly lower. The world is now way different. The forces that lowered all those interest rates are way different than they were then. Globalization is in retreat. For example, onshoring is here. They have monumental federal deficits. Federal deficit is 6% of GDP with a 4% unemployment rate. That would have been unthinkable 10 years ago, 15 years ago, 20 years ago. I mean, with the unemployment rate we have right now, the federal deficit should be minimal, and it's now 6% of GDP. And there's all kinds of pressure for more federal spending rather than less federal spending. So My guess is rates will hang higher. Cyclically, they can go lower. So from the 6 3/4, we could see 6, 5 3/4. But I don't think they go much below that. The next thing is we had when the rates backed up, and this is the 20 city average on Case-Shiller, when rates backed up, we had this the boom in house prices ended where we were increasing home prices nationwide at around 20% annual rate. And that was higher than the mid 2006, 2005, 6, and 7. So this was the record high of all time for home price appreciation. Home prices turned negative, but they're now turning up. There's a shortage. There's basically a nationwide shortage of housing. And my sense is in terms of home prices, you could look at them going anywhere between 2 and 4% a year from here. You know, something like that. Inflation plus or minus 2% would be probably a good way of looking at it. I don't see a home price crash at all unless we have a big accident in the economy, or if rates even go much higher than where they are now. But so look for home prices, you know, call it 3 to 5% a year going forward. And this is nationwide. This is not California. This is a 20 city average. The fastest growing on the Case-Shiller is, by the way, San Diego, which is up over 10% year over year, just to put a little local context on that. Housing starts have stalled out. And you go back, this goes back to 1959. And if you look at previous up cycles, in the early 70s, we went well over 2 million. In the late 70s, we went over 2 million. We went over 2 million in the late 2006, 2007. This cycle, we're not even near that. We're not even close to 2 million starts. So the country had historically had the capacity to produce 2 million housing starts a year. And this time it is not happening. Here we peaked out at around 1,700,000, 1,800,000. And this is starts. Jerry's chart showed permits. This is physical. This is physical starts. So there's a difference. There's a difference in the series. And it looks like, to me, overall housing starts, Jerry has them around 1,500,000. I think it's more like 1,300,000-ish, a little less than the 1,500,000. And that's sort of roughly where we're running right now. So I don't expect an all-out boom in housing. And part of that is the big boom is over for multifamily starts. That's the big swing. Multifamily starts could drop from, say, 600,000 to 300,000, and sort of cut in half on a couple of month basis. You notice in the early 70s, we're doing 1 million multifamily starts a year. 1 million. Now that was due to 2 Nixon programs. He had a 236 program, which was rental housing for low-income people, and a 235 program, which was ownership housing for lower income people. And so all that federal money came plowing in, and it was 1 million multifamily starts. In the mid 80s, we had multifamily starts up to 600,000-700,000 units. And that was basically due to the syndication boom, the tax code changes in 1981 on the tax code. And you had a merger between very aggressive savings and loans and the tax shelter syndicators. Basically, we're just flooding multifamily with a huge amount of starts. And then once the Tax Reform Act passed and other things happened, multifamily starts collapsed from basically 600,000 down to 100,000. And then it collapsed again in 2010 with the financial crisis. But to me, is if you want to look at a long run number, I mean, the next 2 years, my sense of the world is that multifamily starts will be around 300,000 units a year. And single family starts will be about 1 million, or 300,000 plus, 1 million plus for singles. So you get like 1,350,000, you know, something that sounds like the kind of numbers for housing starts going forward. Now, why did the boom shut down for multifamily? Everybody says there's a shortage of housing, we need multifamily and all that. First thing that happened is that the rise in interest rates triggered a collapse in the values of multifamily starts. So what happened is a typical apartment building now compared to say 2020, 2021 is down 25 to 30% in value. Now, how does that happen when rents, everything else, multifamily is supposed to be booming? They're down 25 to 30% in value. Thing is, when interest rates got so low, the cap rate on multifamily housing in many areas got below 4%. So on net operating income, you were paying 25 times, basically 25 times net operating income. All of a sudden, if the cap rate goes to 6%, you're paying 16 times net operating income. So when you go from 25 times income to 16 times income, you get a huge compression in value. Now, these are all on the extreme side, but we've basically had a 25 or 30% compression of value. And this is true in Southern California, even more so in Southern California, because the cap rates got well below 4% here. So you have a much bigger swing on that. So that's the first thing that suppressed value. The next thing is you got all these starts were based on fantasy projections by multifamily developers, thinking that rent increases are going to continue to grow at 10% a year forever. So if you make an assumption that I'll buy it at a 3%, 3.5% cap rate, and rents are going to go up 10% a year for at least for the next 3 or 4 years, then maybe settle down to 5%. You could justify practically any price to pay for a building. And all of a sudden, as too much supply came online, rents started to drop. And I'll give you an example. In places where there's been big increases in supply, rents have dropped. I'll give you an example. Austin, Texas. Everybody's a great place. Everybody's going high tech. New apartment rents are down 9% year over year. Okay, in Austin, Texas, one of the hottest cities, best environments. And let's build a 200-unit luxury apartment in Austin, Texas. And you're pro-forming it, you're going to exit it at 4%, and you're going to assume rents are going to be up 10%. All of a sudden, you're exiting at 6%, and rents are down 10%. You're way underwater, and the bank is going to end up owning the building. And Nashville, a city that I know reasonably well because I have a couple of kids there. And Nashville on the newer projects it's not unusual to see 1 to 2 months free rent on a 1-year lease. And these are sort of on the high end apartments in Nashville. So there's a lot of supply. So what's going on is with all the supply coming on, is rents have softened, interest rates are higher, prices are lower. So why do you start? It's very hard to pencil out a new apartment build. It's very hard to pencil out a new apartment build when assuming 2 or 3% rent increases and assuming an exit cap rate of 5.5% or some number like that. And given what people are paying for land, the numbers and construction, the numbers just don't work. So this is going to severely limit apartment construction over the next 2 years until this excess supply gets worked out. And you sort of see that in pockets of, certainly downtown LA and stuff like that, where there's a lot of supply. You're seeing softness in rents. And then you may get some new supply coming from adaptive reuse. Now, this is the CPI for tenant paid rent. This is what Jerry says was keeping inflation numbers high. This is the tenant paid rent. It's not the owner's equivalent rent that they estimate ownership housing for. That's still running at around 5.5%. So that's what's holding up the consumer price index, well above the 3% or so year over year in the regular CPI. It's holding up a lot. Now, owner's equivalent rent is a little bit below that. The housing component of the consumer price index is 30%, is approximately 30% of the headline and 40% of the core. So the housing component is holding up CPI. So why isn't the consumer price index reflecting what's going on in the marketplace? And let me give you a couple of technical reasons. One reason is the CPI measures in-place rents, is what the consumer is actually paying. It doesn't count the spot rent that you see in the market, like rents for new apartments on Zillow shows $2,000 a month, but if the existing tenant is paying $1,800 a month, CPI is going to measure in-place rents, and those will ultimately roll into the higher rent, the big rent increases we saw previously. And this is what's going on sort of in the real world of, I have three REITs that own multifamily and one that owns single-family houses. Equity Residential, which owns high-end bi-coastal apartments, year-over-year rent increases were just under 3%, well below what CPI says. Mid-America Properties, which is in the Southeast, Nashville, Atlanta, you come up with a place at Memphis, rent increases are only 1.4% year over year. Essex Property Trust, which is on the West Coast, which is basically from San Diego to Seattle, 2.2%. So that's what's going on in the market. That's their measures of in-place rents, but the CPI has yet to catch up to that. And then for single family, I have Invitation Homes, and those are single family rentals, largely in the Sun Belt. They own a lot of properties in the Riverside, San Bernardino here in California, lots in Phoenix, lots in Florida. 4.6%. So some of the people who can't buy single family housing are renting single family housing. And there's a panel today, the Kaufman and Broad's on the panel. And I think one of the questions that should be asked of the Kaufman and Broad person is, how many homes are they selling to investors? Whether it's individual investors buying the house to rent or whether it's Invitation Homes. And Invitation Homes right now in Sacramento is one of the great villains, by the way, in Sacramento, because they have the anti-hedge fund, anti-private equity housing act, or whatever they want to call it, to prevent large-scale owners of single-family housing to do business in California. So they want to limit them to 1,000 units. That is going on, and that may actually pass in the California legislature. So that's something else that's going on. All right, here's single-family rents by CoreLogic. And part of the reason why the CPI hasn't reflected everything is you take a look at this peak, it hit 14%. The highest CPI ever got up to is 9% a year. So there's a lot of catching up to do. And the other thing is all the bulls on inflation staying low and inflation staying down are hanging their hat on rents being flat to down. But if you take a look at this chart here with single family rents year over year, they've stopped moving down. I mean, they're actually beginning to move up a little bit. So in some cases the worst of the drop in rents are behind us, except for some of these big Sunbelt areas. Like in Nashville, I think it's through the system with 2 months free rent. I think we're sort of there. I think Austin down 9% is sort of there. So the places where we've seen the big contractions, those are probably over. And if anything is you'll probably see market rents as measured by all these surveys begin to gently go higher rather than gently go lower. So that's going to keep pressure, I think, more pressure on the CPI than a lot of the people are suggesting. All right. Now, what explains the differences? Well, CPI measures in place. It lags the market on the way up, and it lags the market on the way down. The other thing going on is there's a lot of, when the CPI calls up, they call up people who live in apartments where they're mom and pop landlords. And one of the things that's happened with the internet and all the data available is anecdotal evidence suggests is that a lot of the mom and pop landlords who basically kept rents lower than what they thought they thought it was market, but their rents were really below market, all of a sudden see what's really going on in the market because they have access to the same thing everybody else has on the internet. And and all of a sudden they realize they're renting an apartment for $1,400 a month, thinking it's fair. And all of a sudden they find out that you could get $1,800 a month or whatever the number is. They're beginning to respond to that. And that's not measured. These small landlords are not covered by all these big rental surveys because these big rental surveys are really dealing with the big, large national multi-landlords, the big private equity holders, the REITs and what have you. Those are professionally managed apartments. That's where the rent surveys are coming from. They don't get it from the mom and pop landlords for market surveys, and they're beginning to catch up to what the market really is, and that's putting upward pressure. And then, as Jerry mentioned, is with rent control. Rent control jurisdictions are way overweighted in the CPI, so that would tend to keep them from going up so much. They'll rise 2 or 3% a year, but on a move out, given all of these super increases in rents, on a move out, you get gigantic spikes in rents. So on a move out, you can see a 40% increase in rent. It'll be to a different tenant. And that all of a sudden that goes right into the CPI.
and that tends to make the CPI a little bit higher than it would otherwise would be. So when you hear this, what the CPI measures, it is a lot different from what real estate people measure, professionally managed apartment people measure. It's a different series, but that also reflects real life, because that's where the tenants are. Because CPI is supposed to measure the cost of living, and the cost of living is not based on a spot market rent at an unrented apartment. The cost of living is what somebody's actually paying for rent in that given apartment. Now here's existing home sales, and that's at a depression level. And the realtors, there's nothing for sale. Everybody says, well, there's nothing for sale. And this is back down to where we were in 2009, 2010, 2011. You know, we used to do, you could do 7 million units, 6 million units. We're around 4 million. We're down around 4 million units in the US, and it's going to stay low. And the reason why it's going to stay low is 60% of the mortgages are set at 4% or below right now, of all the mortgages in place. So who's going to move if you're sitting with a 3% mortgage? Why move? You know, you can't downsize, because if you want to downsize, your payment will go up because the mortgage, so people are just locked into, people are very, very smart. They would play Wall Street like a violin. People are all locked in mortgages at 2.5%, 3.5%, 4%. And they're in place. They're not feeling the pain of higher interest rates, and they're not going to, people aren't going to sell. They're locked in. Makes it very costly to move. And here's a simple-minded example. This is nationally 2021 house, $400,000 house with 80% loan to value, a 3% mortgage, $1,350 a month for mortgage. Price is now $500,000 for the same house. Now it's a 7% mortgage, $2,660 for rent. And for Southern California, just double the numbers. You know, that's all. You know, just double the numbers for Southern California. These are national numbers. So the thing is, people are locked in and not going to move. Now, there are other issues associated with that is you have an affordability crunch. So even if somebody wanted to buy a house, income growth has lagged home prices and interest rates. Half the renters are paying more than 30% of their income on housing and utilities. There's a jobs housing mismatch. So it's hard to find demand coming from the rental side because the income isn't there. And the only positive sign is the zoning restrictions on negative. There's still a lot of zoning restrictions on new supply, but that's hopefully beginning to change in some places. In terms of domestic immigration, the states that where people are moving to, South Carolina, this is a net in-migration as a percent of population. South Carolina, Delaware, North Carolina, Tennessee, and Florida. No surprise, no real surprise. Low-cost states, Tennessee and Florida do not have income tax, personal income tax for people. The states losing: New York, California, Hawaii, Alaska, Illinois. No real surprise. And New York and California, Illinois, call them high tax states. So, and this has been going on for a while, and this will likely continue. New issues, and this is, I think, going to be especially important in Southern California. The $500,000 capital gains exclusion for couples no longer cuts it in high-priced regions. Because just run through some arithmetic here. If somebody's in a house with a basis here at $500,000, and it's not surprising to have that same house today be worth, call it, $1.5 million. That's, people, that's not out of the ordinary for Southern California. There's $1 million capital gain, a $500,000 exclusion. So you got a $500,000 capital gain. You tax that at 20% at feds and 10% at California state level. There's a $150,000 tax liability to sell. Why sell? That's going to keep. So my guess is, even though California has all this great liberal delegation in the Congress, when they redo the tax bill next year, I think there's going to be a move to increase that exclusion. I really think there's going to be a move to increase that exclusion, and it's going to come from the great liberals of California. Are going to be leading the charge, because they're going to be supporting their own constituencies. on that. Other issue is the change in commission structure due to the antitrust settlement may negatively impact first-time home buyers because we really don't know how the real estate agent is going to get paid a commission from the first-time buyer in this new deregulated environment. I think it's ultimately going to be worked out, and the market will find a way to make it work. But I think there may be some transition issues that may make it harder for the first-time buyer to enter the market because they may be required to pay some commission up front to get an agent. Even though Zillow could do a lot of work, you're still a first-time buyer, you need a lot of help. You need a lot of hand-holding, especially if somebody's moving into a new area where you don't know the neighborhoods. Other issue which is true here, is the cost and availability of homeowners insurance. That's not in the CPI. Those increases are not there, but they soon will be. But they measure it in a very screwed up way. They measure it the way they measure health insurance. And how health insurance gets measured in the CPI is they don't measure your premium. What they measure is the profit margin of the health insurance company. So they subtract, this is what you pay for the premium, and then this is the medical reimbursement you get. So it's that net price, that's what gets measured in the CPI. They do the same thing for home insurance. So when CPI says, so the CPI's health insurance, what they show for health insurance has nothing to do with the way we experience real life health insurance costs. They don't measure it just in terms of the premium. For car insurance, they measure it in terms of the premium, and that's up 20%. So it's totally inconsistent on how they do that. And the other thing is anti-NIMBY legislation is beginning to impact supply, so that's probably going to help, but that's going to take some time. And then to conclude, era of low interest rates is over. I think housing is going to muddle through. Single family starts will hold in, multifamily won't. So I'm looking at 1,350,000 starts. The CPI will lag the slowdown in rent increases on the spot market. Affordability crunch will continue, and home insurance and capital gains taxes are going to be bigger and bigger issues. This is especially true here. So thank you very much.
Thank you, David. And so now we're going to move on to Sayantani, one of our new economists, who's going to give you a brief introduction to some new research that she is doing. And then we'll follow that with the latest on the Alan Matkins, and then move to a break. So Sayantani, let me turn it over to you.
Thank you so much, Jerry. Thank you for David for all those really interesting insights. Today, I'm going to talk about costs in construction, California index and forecast. And I'm going to open with this graph right here. It shows California level quarterly inflation in the blue line and California growth rate of construction labor cost in the orange line. The California inflation is really the inflation for the San Francisco, Hayward, Oakland CBSA, and the quarterly growth rate in per unit labor construction wage and salary is really just the total labor, the total construction wage and salary in California divided by the employment in construction in California. So in a way, you can think of the orange line as a growth rate of labor cost. And what's important to note here is that, as you can see, the inflation and the quarterly growth rate in labor cost don't always move hand in hand. You can see that there's a lot more volatility in the growth rate of the labor cost. And that is the motivation for today to understand how construction costs are different and how they need to be studied separately. So construction employment costs, and as we'll see later, construction material costs don't always follow inflationary trends. So there is a need to study them separately and independently. Having said that, what I'm going to show you today is a work in progress. It's quite literally under construction. We have some pieces of California construction today which are not exhaustive. I'm trying to incorporate more elements and more moving parts into the construction indices and forecasts that I'm going to create. The ultimate aim is to create a California-specific set of comprehensive indices for construction cost and produce some independent forecasts The current focus today, though, is just going to be identifying some construction inputs and outcomes. And I'll show you a very brief preview of some in-process short-term forecasts. These are not final forecasts at all. They are just to show you the kind of work that I have been involved in terms of identifying what all can be important for California construction. So the scope today is indices and forecasts for California. This is only for California. I'm not looking at any place outside California. I'm also not looking at any subregions, counties, cities within California. This is going to be at the state level. And the components of construction costs that I'll be looking at are material costs and labor costs. I'll also be looking at non-residential construction activity. This is going to be office construction activity, store construction activity, and total non-residential construction activity. Just a brief idea of what the methodology is to just tell you that the way I do the forecasts is using what we call VARs, the statistical method called VARs. And all they're trying to do is really capture the complex variable interactions. Like most macroeconomic variables, construction costs also are determined and determine many other variables, not just at the same time, but also with lags. So it is important to capture how the different variables that are in place are affecting construction costs. And the way that I did that is by using what we call Bayesian VARs. And also, it's important to note that in the sample period that I have, there was COVID, and COVID was creating a lot of deviations from the usual trend lines. So I have adjusted for these COVID-based outliers when doing the forecasts. Moving on, for the components of cost index, we have material cost, and these will be indices at the monthly level. And I have labor cost. These will be indices at the quarterly level. For the material cost monthly index, we have a group of 45 commodities that include, but are not limited to, architectural coatings, hardwood, lumber, lighting fixtures, floor coverings, etc. And the variables used in the forecast estimation are national CPI inflation, national producer price index of construction manufacturing, and the national producer price index of non-metallic minerals. For the labor cost, the index is obtained from a per unit labor construction wage and salary, adjusted for inflation. Some of the variables used in the forecast estimations is inflation in select California Census Bureau statistical areas, total California wages, national construction spending. The whole point of telling you all of this is to just explain that I have tried to incorporate as many of the variables as I think are important in understanding components of cost. However, there might be others, and I'm open to suggestions as to what else I can include. So now let's move on to this graph. This is the material cost index graph. The index base is 1993 January. I have not shown the entire range of dates here. This is starting 2016 and ending in around June of 2025. So I have around a year of the forecast. The construction material cost index seems to be on an upward trend. But as you can see with the trend line, they have always been up on an upward trend. It just seems like for the future, starting from June of 2024 to June of 2025, which is the whole region to the right of the red line, that's going to be on an upward trend. The average rate of increase between July to December of 2024, which is the end of this year, is about 0.6%. Moving on to the labor cost index, the base for this index is 1998 January. The labor cost index also seems to be on an upward trend. The trend line shows that also has historically been on an upward trend. The average rate of increase between July to the end of this year is around 0.34%. Having shown you these two graphs, it's important to mention the challenges in forecasting or even just estimating the index for material and labor cost, because they have very high levels of dispersion, which just means that they are very volatile. So these forecasts should be taken with a grain of salt, not just because they are very much in processing, but also because they vary a lot, just by their intrinsic nature is to be very, very volatile. Moving on to California construction activity, these are not costs anymore. These are total construction activities in California. And This will eventually pivot into estimating the average cost of construction for different building types. I'll show you the building types in just a second. And just showing you this construction activity indices and graphs will establish links to the Allen Matkins UCLA Anderson forecast survey findings that we will soon be listening to. So for the construction activity index, I'll only be looking at growth rates. These are not just index trends anymore, they are growth rates. And we'll be looking at office, retail store, and total non-residential construction activity, all at the monthly level, all having a base of January 1993. And I have shortened the range of dates here just so that you can get a better look at what has happened and what's about to happen. The office activity index seems to be on an overall upward trend too. And what that means is as long as the dark brown line, which is to the right of the red line, which is what's about to happen, as long as that line is above the zero black horizontal line, it means that there is a positive growth rate, which means that there is an overall upward movement in the index. The average rate of increase between July to December, so end of this year, is about 8.32%. And this may just be, and I'm completely speculating here, this may just be symbolic of how there are higher costs for office amenities now. Moving on to retail store activity, as you can see, the dark green line, which is between July of 2024 to July of 2025, most of it is under the zero line, which means that the growth rate is negative, which means that it's on an overall downward trend. The average rate of decrease for retail store activity is from July to December of this year is around 0.05%. And that's just symbolic of a slowdown in the retail store construction. For total non-residential activity, it seems to be going up in line with the forecast for the non-residential construction activity valuation. The average rate of increase is about 2%. And there is a lot more to come. So I will try to coalesce these different components of construction cost to estimate total construction cost for one comprehensive index that's going to tell you what's going to happen to construction. I'm going to try to achieve higher geographic granularity because California is a huge state. We need regional idiosyncrasies incorporated. And I'll also try to increase the accuracy and create longer term forecasts because all we saw today were very short 1 year forecasts. I'll try to increase the range of those. And yeah, that's all for today. Thank you so much and stay tuned.
Thank you, Sayantani. And next year, when we do the real estate themed conference, you'll see a lot more, but this is research that we've been thinking about for quite some time. And now Sayantani is making great progress on that. Now we're going to turn to the Allen Matkins survey, which just finished. And so we have some preliminary results, and I want to introduce our speaker. It's Spencer Kalick. Spencer is an operating partner of the Century City office of the law firm of Allen Matkins. He provides his clients with concierge legal services. He is an expert in navigating the very complex system of regulations and laws, including CEQA and zoning, and it goes on in California. And kind of as evidence of his expertise, his client list runs through all kinds of companies that you know, including Blackstone, Cedars-Sinai, JP Morgan, Kilroy, and so on. Spencer was named one of Southern California's rising stars by Super Lawyers in 2022, Best Lawyers in America 2023-2024. He was educated at Northwestern University and at Loyola Law School, and is a native Californian. Spencer, welcome to UCLA, and let me turn the dais over to you.
Good morning. Thank you, Jerry. Nice to meet you all. And what you forgot in my bio is actually I was born at UCLA Hospital. So I do have a UCLA connection as well. I am a Bruin. Yeah, exactly. And my father went to UCLA. My mother worked at UCLA. So We have UCLA basketball tickets still, so I still feel very connected to UCLA. Thank you, Jerry, for the introduction. Again, my name is Spencer Kallick. I'm an attorney at Matkins. I'm going to try to keep the numbers to a minimum this morning because I am not an economist, and you don't want to ask lawyers about math. But I'm going to do my best to tell you a bit about the survey. Matkins has partnered with UCLA Anderson Forecast since 2008 to issue its commercial real estate survey twice a year to better predict future California commercial rental and vacancy rates on office, industrial, retail, and multifamily assets up and down major geographical markets in California. As we've all been living in it, commercial real estate has been impacted by the level of uncertainty in the economy, and you've heard a good deal about that today: higher interest rates, slow economic growth, and legislation. And so our summer survey has just been completed. The monograph will be released in July, and I'm here to present the very preliminary results. And as we review the survey results, please note the index is designed to project market conditions 3 years out. So that'd be 2027. And I had a chance to chat with Jerry yesterday a little bit about some of these preliminary results. And actually, I think some of them are pretty interesting. Not all the bad news that you may be thinking. I think there's some hope in the horizon, and we're going to chat a bit about that. So let me go to our first slide here. There we go. We're going to start with office, which is everyone's optimistic area these days, right? Everyone knows the office is doing phenomenally well. Our most recent survey from developers in the office market is that office is the most negative sentiment, not surprising. However, there are some bright spots. It's a little surprising. You'll note that in San Francisco and in Silicon Valley, our panel believes that we will recover in 3 years' time, and that those areas are going to be more rapid than other parts of California. As a native Angelino, a lot of folks here know what's happening in Los Angeles in the office market, but I can say anecdotally, I was up in San Francisco and Silicon Valley a couple weeks ago, and I would say things are way better today in San Francisco than they are in downtown Los Angeles, pretty much or any office market in Southern California right now, save for maybe Century City. But otherwise, things are looking up, and our experts believe, our panel believes that things will be looking better in San Francisco and Silicon Valley in the coming years. Our retail survey panelists believe that the recovery in the retail market is trending upwards and back everywhere, interestingly enough, except in San Francisco. And as I walked around Union Square a couple weeks ago, I think that that's probably true. There's a lot of vacancy up there. But again, we're looking out 3 years into the future. And for retail to thrive in San Francisco, people need to be going out to stores, have new housing developments. San Francisco is really dependent on tourism and people going back to the office, and that's why the recovery is going to be take a little longer in San Francisco. Industrial, not surprising, is a hot market right now. Everyone is optimistic in all areas except the Inland Empire. That may sound bizarre because Inland Empire is king of industrial, but it's because the overheated market in the Inland Empire right now, basically, and market demand and the moratorium is that vacancy rates. It's a lot harder for vacancy rates to get any lower than they already are today. And then multifamily, we talked a lot about that this morning. Everyone is optimistic about multifamily pretty much everywhere. This is the star performer in the currently of all the 4 sectors. Southern California, we're expecting to see a bit of new building coming this year, but a little less so in Northern California. And this rise in the market should spur growth in housing and the easing of rental rates going forward. I can tell you anecdotally, I'm a land use attorney. This is what I do for a living every single day. And I always kind of get to hear the different, excuse me, things that our clients are looking at and thinking about. Kind of first, I seem to get the first phone call, and everyone and their mother literally is talking about multifamily right now. It's the #1 phone call that I get. I probably have about 30 or 40,000 multifamily units on my desk right now in various stages of entitlements, from, hey, what can we do here, all the way up through the city council meeting that I have this evening for entitlements. So, and it's frankly all across Southern California, in all the places you would expect, in places like Culver City to West Hollywood, even Beverly Hills, but down to San Diego, Orange County, up in the Bay Area as well. We were very, very active in the multifamily space, entitling. I didn't say building, but entitling, right? Everyone wants to entitle the next couple of years in hopes that a couple of years from now that they will be in a position when hopefully interest rates go down. I don't know, maybe not to as low as they should, but that they'll be able to pull permits. So what we're getting in these survey results is that increase in building multifamily is real, hopefully, and it's all over California. We also have a burst in home development taking place after years of lackluster development. So we encourage you to review the latest survey results in detail, which will be released in July. Survey may be found on the Alan Matkins website, alanmatkins.com, and the UCLA Anderson Forecast website. If you have not been receiving that survey in your inbox, interested in getting it, feel free to send me an email, askhalleck@alanmatkins.com. And we want to thank all of you for coming out this morning and appreciate the partnership that we have with the UCLA Anderson Forecast and with Jerry as well. So thank you.
Thank you, Spencer. And, you know, one of the things that you probably noticed through my presentation, through David's presentation, through Spencer's presentation is a lot of the forecast or the outlook for residential construction and multifamily housing depends on timing. And the second part of our program, after we have a short break, is going to really dig into that. We have our keynote, and then we have an excellent panel that is put on by the Ziman Institute for Real Estate. So we're going to take a 10-minute break. And during that break, for those of you in our in-person audience, please feel free to engage us with questions. We have such a packed program today that we don't have like a 20-minute Q&A period. But during the break, by all means, ask questions if you have them. And so it is now 10:33 by my watch, which may or may not be correct, but by my watch, 10:43, we will start again with our keynote, and we will see you all again then. Okay, welcome back. Now we start the second part of our program, and we're going to begin with our keynote. And our keynote speaker is David Benson. David recently retired as president of Fannie Mae, the largest provider of mortgage credit in the United States with over $4 trillion in assets. As president from 2018 to 2024, he was responsible for each of the P&L producing business units, single-family residential and multifamily, as well as several corporate functions, including finance, IT, operations, strategy, human resources, and communications. He pioneered the formation of Common Securitization Solutions, a Fannie Mae Freddie Mac joint venture that develops and operates a cloud-native platform, which enables the $7 trillion mortgage-backed securities market to achieve enhanced levels of liquidity and standardization, and was served on the board from 2015 to 2024. Throughout the great financial crisis, David played a critical role in transforming Fannie Mae's business model. He was CFO from 2013 to 2018, and again in 2021, leading the company to record levels of profitability with a focus on business innovation and modernization of financial reporting infrastructure. Prior to his 22-year career at Fannie Mae, he managed several businesses in institutional fixed income for Merrill Lynch, based in New York and in London. He holds degrees, an undergraduate degree from UCLA. David is a Bruin, and also an MD from Harvard and an MBA from Stanford Graduate School of Business. And so please join me in welcoming David.
Thank you, Jerry. It's a pleasure to be here with you all. It is great to be back at UCLA. I think it's my first time back in 43 years that I've been back on campus. So I was very excited to get the nod to be asked. I did just recently retire from Fannie Mae a month ago. It's my 1-month anniversary, I think, from when I left. after a 22-year stint there. So let me just say that any of the comments that I make are not official Fannie Mae comments. That was a positive. When Jerry contacted me, I was still at Fannie Mae. I don't think he knew if I would what I was going to be doing, and I said, I don't think I will still be here because I'm leaving. And he said, that's okay, because you'll be able to be more honest, I think, when you're here. And I said, that's probably at the margin. That might be true. And just so you're all aware, Fannie Mae underwrites approximately a quarter of the mortgage market, or a quarter of the single family mortgage market, and about 20% of the multifamily market, over $4 trillion in assets. And it is very profitable, notwithstanding all of the stuff that happened around the great financial crisis, which I'd love to talk about, but I think we're going to talk about other things. But last year earning over $17 billion. So again, it's been a nice turnaround. All right, so housing. Some of the things that I was going to talk about are going to be very familiar because David Schulman did a really nice job of talking about some of the affordability issues, interest rates, lock-in effects. So what I thought I would do is I'm going to show you a series of slides that dabble into much of the kinds of issues that you've already heard about, but I'm going to give you a little bit of a Washington kind of angle on things and a little bit of a risk management angle in certain things, because Fannie Mae ultimately is it's a risk management organization that ends up carrying a lot of the risk of from a credit side of what's happening in mortgage. So let me start off with, in terms of home prices. So the home price picture for us at Fannie, we benefit obviously when home prices are doing well because the collateral that underlies the mortgages that we guarantee. Think of Fannie Mae, if you want to think of it simply, it's a big insurance company. It's insuring the payment of mortgages that are out there. And so when people are paying their mortgages, Fannie Mae's making money. And if people stop paying their mortgages, Fannie Mae's going to be on the hook and they're going to lose money. Okay, just think of it very simply that way. So when home prices are doing well in general, people typically are paying. If they stop paying, there's things you can do. They've got a lot of equity in the house, even if they need, there's ways you can get out where you don't literally lose a lot of money when they go delinquent if they can no longer be there. But when home prices go down, that's where you can see a lot of problems. So think of it from that perspective. The thing that's really been concerning to us is, by various measures, you could really look at housing over the United States right now and claim that it's as extremely overvalued as what we saw prior to the great financial crisis, and we know what happened there. Now, the conditions are completely different. The manner in which mortgages are underwritten is completely different. The things that were creating the bubble in the 2000s are completely different than the conditions what you're seeing now. But nevertheless, when you just look at long-term trends, they're very, very overextended. So much so that it actually impacts the way that Fannie Mae thinks about the capital that needs to hold against a mortgage. If we do an 80 LTV mortgage, so 80% loan to value, what we would actually think in our mind in terms of the capital, we may be doing more like a 97. In other words, if you're 17% over where you should be, if that's where you're marking it, you actually you look at the capital that you might require for a 97 instead of an 80. Now, that's not necessarily impacting the price that Fannie Mae is currently charging in the market for various reasons that have a lot to do with policy in Washington, D.C., but it does affect the way that we think about it from a risk management perspective. So the real question is, are things really 17% above trend, or has there been really a permanent change in the propensity to consume housing in the United States? We'll only know after the fact. I don't know the answer to that. I mean, you could basically claim that baby boomers have a higher propensity to want to stay in their homes than other generations, and there's all kinds of other things that may create that. But it's a big issue in terms of thinking about the risk management of this asset going forward in terms of how to look at things. All right, now the numbers here are very, very similar to some of the numbers I saw David share with you, just in terms of what's happened to the cost of a mortgage if you're thinking about from a couple of years back to today. So you have both home prices having gone up in an extreme way over the last few years, And then you've got the interest rate effect, what's happened where mortgage rates have effectively more than doubled during that period of time. And so what we've actually seen is that the cost of a mortgage for somebody who's entering into the system could be easily double. And I think David showed something that was roughly equivalent to that. It was almost double basically over the last few years. For Fannie Mae, this is a huge issue because when you think about the mission of Fannie Mae, it's liquidity, stability, and affordability. And if this on the affordability side is bad news from an organization that's wanting to do well on that. So there's obviously this creates a lot of problems in terms of how we think about what we're trying to do to be able to make things more affordable. All right. This chart, I'm hoping that what will happen is I will end up leaving this chart with you. Some of you will take a picture of it. Some of you will look at it because you could claim that it was a child that scribbled something down, and you probably would be right. But the reason I show this is in part because it was so popular at Fannie Mae. I'm still trying to figure it out, but what it's attempting to do is on the x-axis, it's giving you the mortgage interest rate. And on the y-axis, it's giving you a ratio of home prices to the median income of household income. And so things are getting on your y-axis as you go up that axis house prices are becoming less and less affordable in terms of versus the income. And when you look at the x-axis, what you're trying to do is see what is the relationship, because obviously if interest rates are lower, you would expect that people should have a tendency to be able to afford more, even if their income is roughly the same. And so there is kind of a light trend line that's been drawn there. And anything above that trend line, this is going back many, many years, would supposedly tell you that something's going on above and beyond what should be going on just with interest rates themselves. And what you can see is you see that loop that's kind of in the center, that was that period prior to the financial crisis when things were overblown. But then you look at what's happened in the last several years in the 2020s, and things are even far worse than that. So it just sort of highlights how unaffordable things are, even when you take into extent kind of what the interest rate picture has been. And if you look back at the last time we had 7% mortgage rates, you saw in the 1990s, early 2000s, you had a far different picture in terms of what the house price to income ratio looked like during those periods of time. So this is, well, again, I will welcome any comments about this particular slide. And if you can figure out what it really means, that would be great. All right. So the other thing that we've discussed in here, I think, has been what's been happening with rents. This is the other picture. I mean, at the end of the day, housing may be really expensive. People need to live somewhere. So if houses are really expensive to live in, then the question is, can people afford to pay rent? Because you got to be somewhere. And there's been, over time, there's been stress there as well. I agree with the comments that were made about rents having gone up quite a bit over time and that have really cooled off. That is consistent with the data that Fannie Mae has as well. There was a lot of supply that came on the market. It's been mentioned again. David mentioned that. A lot of supply of multifamily came on the market. That hasn't been completely, it hasn't been absorbed fully in the market, and that's keeping rents down now. But having said that, the picture has been that there's been difficulties in affordability across the board. And we have a tendency at Fannie Mae to kind of look at those people who are in the most need and where we find real stress there. But the one interesting statistic and this came from in 2021, we had estimated that 39% of renters could afford an entry-level home. But then when rates went to 6%, okay, so when they went from 3 to 6, only about 13% of renters could afford to do that. So there was a huge drop off in the ability for renters to be able to move into home ownership if that's what they chose to do. All right, I want to talk a little bit about rates. What I want to focus on in this move in rates, I'm going to focus a little bit on not just the level, but sort of the makeup of the mortgage rate, because I think it's important to see what's happening there. So the blue line, the lower line there is the treasury rate. The higher line is the mortgage rate, and these are not the same. Mortgage rate's higher than the treasury rate. What I'd like to do is just kind of show you a little bit of a buildup. Now, I'm sorry, these rates are a little bit higher than where we are in the market today. I think I created this slide a few weeks ago. But if you start off with the 10-year treasury, and then you build up to what the mortgage-backed securities rate would be for a Fannie Mae mortgage in the market, the difference between those two rates is called the secondary spread, okay? And that secondary spread is basically what the market will charge to be able to provide a guaranteed instrument that is the cash flows of the mortgage, where they know that they're going to get paid, because if the person who has the mortgage, who is the borrower, can't pay, then they know Fannie Mae is going to pay. And let's, for all intents and purposes, assume that the market believes that that's going to happen with 100% certainty. So why do you have this spread between, let's say, a 10-year treasury and this? Well, a couple of things. Number one, you're looking at a 30-year asset. It's prepayable, and a big component of it is this option to be able to prepay. A treasury of a 10-year, you have certainly a 10-year instrument. Here, you've got it could be a 30-year instrument that's going to amortize. It could be an instrument that's going to get paid off tomorrow. You don't really know, and that option's worth a lot. But the component I'm really going to be focusing on in a minute is what I'm calling a liquidity premium. And something's been driving that particular equation in a meaningful way that I'll get into in a sec. Lastly, just before, because I'm going to go to that, I'd like to just mention the next level to get to a rate that you see in the market, let's call it the 7+ rate you might see today, is not just that MBS rate, but then on top of that, it's all the fees that are involved in a mortgage, the servicing fee, the origination fees, and Fannie Mae's fee. And just to highlight this, Fannie Mae charged prior to the financial crisis, on average, call it 15 basis points, okay? Today, Fannie Mae charges, just for its own use, over 50 basis points. Now, on top of that, the government has tacked on another 10 basis points for itself. So it's kind of, let's call it in the 60s, where it used to be 15. The 15 was too low, for sure. The cost, this kind of 60s away from the 10, there's the 10 that the government gets as more of a tax. A lot of it's due to the assumption of how much capital Fannie Mae needs to hold for what it does than what that capital was to be before the crisis. If you want to go back to the whole financial crisis thing, one of the problems was that there wasn't enough capital that was being held against the risks at the time. So that's been addressed in terms of the regulations have addressed that. And in that, the fees have had to go up to be able to make up the difference in that. Let me get back to what I wanted to say about the secondary spread. So now we're going to get back to that liquidity premium. One of the biggest drivers of that liquidity premium happens to be the Federal Reserve. Now, why would that be? And the reason that is because the Federal Reserve has become the largest single holder of mortgage-backed securities in the market. And they peaked out at about 2.7 trillion. They're now, I think, closer to 2.3 or 2.4 trillion. And what this chart shows, if you were to map out their activities, what you would end up seeing is that whenever they've announced that they were going to be a buyer, that spread would come in. Whenever the assumption was that they were going to either stop buying or that they were going to perhaps let their portfolio run down, you've seen a widening in that spread. And you can really trace that, and it's pretty. The Fed was not a price-sensitive buyer for mortgage-backed securities. They didn't care whether they had good value versus one asset or another. They literally said, here's how much we're going to buy. They would go in, and over a period of time, they basically would do that. And they would do it in the most efficient manner they could. But the point is, they weren't what I would call a price-sensitive buyer of mortgages when they were buying. And when they've been not buying, it's been because they've wanted to reduce their portfolio. It's really not been about value. So the question that really comes up in this market is, with the Fed really basically having told us that they're no longer really want to be a participant in this market in this way, who will buy these? Now, again, there's a very, very big liquid market for it. They're not the only buyer, but it really comes down to a question of what spread is the spread that the market will want to buy these mortgage-backed securities at. And the big players typically have been banks, they've been mutual funds, they've been, all sorts of different asset managers, central banks throughout the world. So you've got a big institutional market for this, but all of those parties care about the spread that they're buying it on because they're looking at that spread versus the other investments that they may have, and they have what's been happening in the banking systems in terms of regulations and capital requirements and liquidity requirements. All that would do affect how much banks will be involved in the market. All right. Okay, so one of the things that David, I know, talked a little bit about was existing home sales being down, and this is the lock-in rate. And again, this is just a graphical representation of what he was talking about. I think your quote, David, was something like 60% of mortgages being below 6%, below 4%. What I had here was something like on the Fannie Mae portfolio, 75% of mortgages having at least a 2% lower than the current rate, and then another, I think 12% or 13% that were at least 1%. So the bottom line is close to 90% of the market is so far away from considering doing a refinance that it's not even funny. And if you think about it, this is an enormous value on the balance sheet of the homeowner on the liability side. In fact, the way I used to put it was, and this was when people in Washington hadn't quite figured this out. It was in the early stage of the interest rate increase. And I kind of said, it's as though somebody just got a 30-point gain, a 30% gain in their home value, but it's on the liability side. Do you expect them to sell? And they looked at me and it's like, oh, like it was, Washington is also kind of like lawyers. You don't do numbers with the people in Washington. So that came as a little bit of a surprise to them. So this chart here, the listings are down a lot, I think. So that looks very, very similar to, I think, what we saw there. And then really, so the real question's been, what's going to be the solution to this? And of course, the answer on all of this, both in terms of home price and everything else, is more units need to be put out there. And the real problem, and this was something that Fannie Mae, I think I want to give credit to our team who were focused in research at the time, and it would kind of in the stages of the financial crisis, post-financial crisis period, is realizing that the cumulative nature of the lack of supply that was being generated over that decade, as we were going, was huge. It's not just, when you see these drop-offs, say, oh, we're down a lot from where we were, but you add that up year after year after year, and demographically, you're just not keeping up with what's going on. And of course, we do have migration into the country. The country's population is expanding, and then so you don't have enough supply that's being created, and then now you don't have people wanting to move. Now, let me just say one thing: the lock-in effect of people not leaving their existing home, I'm not quite sure that has a big impact on mobility, choice, where people live, and all that. But it doesn't really create new supply. I mean, if you think about it, if I sell my house and I leave, I got to live somewhere. So there's no net supply that really happened there. I mean, it affects the transactions. If you're a mortgage banker, you're being crushed because there's no transactions. But in terms of the way that the supply problem has to be fixed, isn't going to become people all of a sudden decide that they want to sell their houses. I mean, the supply has to be, because new things have to be built, whether that's apartments, whether it's houses. Ultimately, that's where they'll have to go, as long as you have population. Now, again, in the short term, you have the effects of not having existing houses and so on and so on. But net, people need to be able to move somewhere. We are seeing, as you would expect, even in the first-time home buyer category, more and more people are focused on on new home purchases. The new home purchases are becoming a larger part of the market, as you would expect, given the lack of existing supply. But there's an area that I'd like to focus on here that I don't think came up in your talk, which would be something that we at Fannie Mae thought about a lot, and that's what I would call the sort of equity in housing issues. There's been a persistent gap if you look at where homeownership is for the white population versus the Black homeownership population. It's been about 30 points, and that's been pretty consistent for a long time, decades. I mean, that's not something, and we look at this and it becomes a very depressing kind of thing, because when, trying to figure out what to do about this, to be able over time to be able to see some equilibration and trying to figure out what are the problems that are in the communities, to be able to give and make sure that people from all communities have an opportunity to be able to be involved in homeownership to the extent that makes sense for them. And so some of the ways that, which I think I was really excited about, that have really kind of started up in the last few years, and I think there's going to be a lot more going on, is sort of the innovations that are happening in terms of trying to figure out whether we can underwrite in a way that takes into account the way that people work, that may be different than what we had seen in the past. So what we're now able to do, first of all, is, I don't know if people realize this, but when you were paying rent, it was not showing up in your credit report. There was so you could be a renter, and all the credit agencies were actually taking in might have been your credit card payments and things like that, but your rent payments weren't even kind of part of the equation in terms of getting a thing. Well, we've been working on getting that changed, and it's begun. We're both getting apartment owners to be able to send that information into credit agencies, but again, that's a slow process, but that's continuing. And we're also using what we're calling cash flow underwriting, where we'll basically take people's bank statements, and we'll use data analytics to be able to evaluate what that data is actually telling us in terms of what people are actually doing in terms of their cash flows, in terms of payments, and using the rental payments through that to give them the benefit of that in our own scoring. So even if the credit agency hasn't taken that account, Fannie Mae is taking that into account. Education programs or special purpose credit programs specifically to be able to help people with things like whether it's down payments or other fees. This is another area that people are focused on. It's becoming a bigger thing in Washington. You probably have heard some of this. The CFPB is out there, and there's a lot of discussion about title insurance and some of the other fees, and seeing what can be done to be able to be innovative in that space. Really, really hard to crack, because there's so many vested interests out there who basically they make their money in these industries, and you can imagine they have really good lobbying firms, and they do a nice job of being able to get their congressmen to oppose. But there is a lot of work that's being done to see if things like whether it's title insurance appraisals. There's a lot of good work that was done in terms of appraisal work, where you don't literally have to necessarily have an appraiser come in. You can do things, digitally. There's a lot of information that's already been calculated. In fact, there's many transactions can really be done. In particular, a lot of refi transactions where you effectively can have a much cheaper evaluation done without having to have a person actually come to the place. So that's an area that I think there's some. I would expect innovation will really help. Okay, the last issue I want to dabble into also came up in David's talk. It's a little bit of the whole climate related issues. Okay, so the incidence of significant climate issues has been increasing. It was an all-time record in 2023, and we kind of measure let's call it the $1 billion effects, and we inflation. We take into account inflation, but even when you do that, $1 billion event today is a lot less than, let's say, $1 billion event would have been 20 years ago. We've taken that into account, and even when you do that, the number of these incidents are growing by quite an extreme measure. It turns out, just for whatever it's worth, Fannie Mae hasn't really, in the face of all of that going past, even when you go back and look at Katrina, which was, everybody remembers Katrina in New Orleans, has not historically lost a lot of money in these situations. And why? Well, because of property insurance takes up a good amount of this. So people have their property insurance. But the other thing has been, in some of these real disasters, the federal government's come in and done all kinds of stuff to smooth things over. So that's historically what's happened, but that's not, what you can kind of count on, and things are getting worse. And as I think was discussed, the property insurance rates are now increasing. They haven't, it's kind of interesting. It's taken a while for them to catch up. Some of the other costs of housing that people are having to deal with have actually been going up at a higher rate. The insurance stuff is just starting to happen, and some of it's because of the regulations state by state in terms of what, and you all, I think, here in California know a lot more about this than me. Some of the regulations are in, and so instead of what happens is the rates don't necessarily go up, but then the insurance companies just leave. And you have that issue. So you not only have this issue of, well, maybe my premium is going to be really expensive, but you have the issue of, oh, there isn't even an insurer to be able to insure me at all. Now, by the way, when you have a mortgage, you have to have insurance. So let's just say that I underwrote you, you've got your insurance, everything's fine. Your insurer leaves, you can't get insurance. What do? Well, you have to get insurance. You can lose your home if you don't get insurance. And there are systems that set up that servicers will actually, what's called forced place insurance. They will put you into insurance, and I promise you, those insurance policies will not be very good, and they will be very, very expensive. So this is a big problem that is upon us and getting worse. And it is not just a California and Florida issue. We hear a lot about what's happening in Florida for various reasons. California, you're all very focused on, and there's a lot there, but it's actually happening in a lot of parts of the country are experiencing insurance issues in terms of availability and cost. I mean, we see a lot of issues that are down in Louisiana in particular for, in the Gulf region and in other places. And you're continuing to hear about some of these climate related disasters that are occurring, throughout the country. If you kind of think about it, Fannie Mae, if it's got $4 trillion on, is so exposed to this, it's a little bit scary, right? And there's not a whole heck of a lot that I suppose you can do about the $4 trillion, but the question is, what's going to happen going forward? And I will tell you that the first thing is that what has not yet happened is that when you go to get a mortgage, there isn't, as far, at least as Fannie Mae's processes go, they don't take into account and look at you and say, well, let's say, here's what your insurance rate is today. We expect that your insurance rate is going to be this or that. There isn't an evaluation of the future that's embedded in the underwriting decision. It's a spot underwriting decision of what is today. So you have to have the mortgage, you have to have the insurance. As long as you have the insurance, you're viewed as being okay. There isn't a difference in price that you see depending upon where you are in the country. So let's say you happen to be in a fairly innocuous part of the country where climate isn't really an issue. There aren't wildfires, there isn't flood, whatever, and insurance is reasonably available. Fannie Mae basically will charge you the same kind of fee for your default probability as if you were in Coral Gables, Florida, or something like that. Where Hurricane Ian is about to hit. Now, why is that? We obviously, Fannie Mae, they're not stupid people there. They're very analytic people who actually know. A lot of this comes down to, one, is being able to have good, strong analytics around all of this to be able to make decisions that you actually feel comfortable with. But the next thing, and there's a lot that's going on there, but the second thing really is it's a policy. When you think about Washington policy, could you imagine if Fannie Mae came out and said, what we're going to do is we're going to charge people in the coast of Florida different than we're going to charge somebody, let's say, in Idaho? Think about, or we're going to do something different in California than what we're going to do in New York. So I mean, the political piece of this is extraordinary when you think about a national lender like a Fannie Mae. So all of that's going to need to get worked out. I mean, the risk management of this situation is a big issue that we're going to hear more and more about over the next several years. So I guess just a few last thoughts here on some of these issues. One, the housing supply issue is a really tough one from a federal side of things. I mean, by the way, Fannie Mae, when I think of what we do there, we have almost no impact on supply. the whole equation's been on demand. We're a demand side organization primarily. I think the company knows how to do that, but we don't, other than the LIHTC program, which is a low income housing tax credit program to build affordable housing and multifamily. Fannie Mae just doesn't, we don't build houses, we don't build apartments. That's not the piece that we do. The federal government has a tough time in trying to figure out what it's going to do on housing supply, because a lot of the issues that constrain housing supply are not federal government directed. A lot of stuff happens at the more local level, whether that's state, local, and the things that in zoning and all the rest. So it's a tough problem from the federal side of things of what to do, but that obviously it's becoming a national issue that you hear more and more about. On the access to credit side, that's where I think things are actually going to get more interesting and better, because I think that's where data science can really be applied. AI tools can really be applied to be able to really underwrite people in a more fair way, to be able to understand what people can afford and so forth. But again, there will be issues in terms of some of the things we talked about in terms of climate and things like that. And last on climate is really a lot of focus needs to be put on the resiliency of existing property. For the most part, many jurisdictions, new home, construction regulations and things like that are going to, help for the new housing that's brought on board. But there's, the existing housing and it is going to be, and there's a lot of these communities where the properties are just not built to be able to withstand the kind of stresses that they're going to see over the course of the next, decade, 2, 3. And so I think a lot of what the focus will end up being is trying to do resiliency of these existing properties in terms of retooling, and having some of the properties upgraded in terms of what they're capable of being able to withstand. So those are my thoughts. I want to thank you for having me. It's great to come back, and appreciate it.
Thank you, David, and thank you for coming all the way
Sure.
out from Washington. I think we have
Thank
a
you.
couple of minutes here.
Okay.
In case there's a question or two while our panelists get mic'd up. So the panelists, the miking up is going to be done in the back, and you're ready to go? Okay, so let's take one or possibly two questions, and if the panelists will come on up and we'll start the panel. Do we have any questions? David, I'm sure you have a question, right?
No.
Okay, so I have a question. Well, if you want to bring the panel up, let's go back to the insurance question.
Yep.
If Fannie Mae is not discouraging people from living in Louisiana,
Yeah.
what's going to happen to the solvency of Fannie Mae?
Yeah. No, look, from the good news probably is that the percentage of Fannie Mae's portfolio that's in Louisiana might be pretty low. So even notwithstanding,
kind of more
but
generally.
having said that, look, that problem has not been solved. There's not currently a mechanism for Fannie Mae to be able to say no to Louisiana underwriting on the basis of that. Now, there are standards, the same kind of standards that go in terms of appraisal. What I would expect is going to happen in a lot of these communities over time is that the home values will decline. Now, for the existing book, that will not look good. I guess for the newer book, again, the markets are going to end up shifting over time, and capital will either go into or come out of many of these markets. But as a national lender, Fannie Mae will need to fight the battle inside of Washington to be able to get the ability to differentially discriminate against in some of these areas over time. But again, a lot of it will be a political discussion, I'm sure, and it's a problem that hasn't been solved.
My first picture was gridlock in Washington.
Yeah, that's right.
Great, thank you.
Thanks.
So, okay, so now we turn to our panel and we'll drill down locally. Let me introduce my colleague, Professor Stuart Gabriel. Stuart is the faculty director of the Ziman Institute for Real Estate, who is partnering with us on this conference. So welcome, Stuart.
Good morning, everybody. First thing to do is to congratulate Jerry and the entire forecast team. Really, really excellent program, extremely important. Single bit of it, and we're going to wrap up now with some perspective from the trenches, so to speak. So we're going to have three very deep and experienced people in different pieces of the housing sector and reflect upon some of what you've heard here this morning. So let me introduce the panel, and then I'm going to introduce the topic a little bit, and then we'll move forward. So to my direct left is John Fenn, and John is a senior executive at KB Home. KB Home is headquartered about a mile from here, right down the street on Wilshire. KB is one of the largest publicly traded home builders in the country. It focuses on market rate, affordable housing, which is largely built in the more affordable parts of California and nationally. And KB has, in some respects, almost an insatiable demand for their product based on the fact that they seek to maintain affordability in a time when housing is so unaffordable. To John's left is Tara Barushkas, and Tara is one of the most prominent affordable housing players and developers and managers and innovators and thinkers in our area, and she currently serves as executive director of the Community Corporation of Santa Monica. So Tara's going to drill down and provide insight with respect to the affordable sector. And to her left is Ken Cahan, and Ken is a market rate multifamily housing developer, the principal of California Landmark Group. But beyond that, I would say deeply civically minded individual who is very, very involved in local regulatory issues and local regulatory politics, advises mayor of LA and many others, and makes it his business to be just incredibly knowledgeable in the public policy space as relates to affordable development. So we have here covered market rate, single family affordable development, market rate, multifamily affordable development, and affordable, which comes oftentimes with public subsidy. But let me thank you all very much for being with us today. Before we get into the Q&A, let me say the following. We started the day with a macro forecast. The macro forecast kind of more or less indicated business as usual, indicated roughly a 2 to 2.5% real GDP growth rate, indicated roughly a 4% unemployment rate, indicated mortgage rates that might trend down a bit in the context of maybe 100 basis points of Fed easing. So we have that. We have, very significant housing briefing from the two Davids, both very, very informative, very interesting. Let me focus on one piece of this. House prices are high, mortgage rates are high, mortgages are unaffordable, owner-occupied housing is unaffordable, and in most parts of the country, rents are unaffordable. So when you look at rent indices, you'll see that rental affordability is almost off the charts, unaffordable, despite what David has said about some improvements in rents and here and there in a number of markets and segments of those markets. If you look at any standard owner-occupied housing price affordability index, you'll see the same. And of course, it's been indicated across the board with respect to mortgage interest rates. Now, mortgage interest rates we focus on because they're a primary ingredient in that squiggly chart that David put up. And in fact, if you take that chart and do something very simple with that chart, which is just forecast house prices going out a year, you can write down the 25 number or the 26 number or whatever. You can take inputs from house prices and mortgage interest rates, whatever. And of course, when you do that, and I did this very quickly, not even back of the envelope,
But you're gonna see that the dot that you saw for 24 is gonna be similar for 25 and 26. In other words, the bottom line is the bottom line that David provided, which is that things aren't getting really much better in a material salient foreseeable way anytime in the near future. So with all of that, and let me just add to David Chillman's comments in the following sense. We've focused on mortgage interest rates, but as David said, that's not the only interest rate that matters. And so you all know one of the first things we teach in business school about any interest rate is that it's the sum of a risk-free rate and a risk premium. And the risk-free rate comes from the Fed, it comes from the Treasury yield curve, and then the risk premium comes above that and relates to whatever sector you're talking about. Here we're talking about different sectors of real estate. But David Shulman referred to cap rates. And I think he may have wanted to refer to discount rates as well. Both of those completely integral to the valuation of multifamily products. Jerry and David Urson talked about mortgage rates, et cetera. And all of these rates are negatives for development, for valuation, for demand, et cetera. So we have negatives across the board in the real estate sector that relates to affordability. So here we go, panel, let's get to work. The first question, and honestly, my questions don't matter at all, so just say whatever you want. Really just get into the most salient meat that you've brought for us today, because I know you've brought good stuff. But here's my first question. It dates back, Jerry and I don't think David's veteran of Wall Street, but Jerry and I are veterans of the Federal Reserve. And whenever we do forecasts of the Fed, we do all this like quantitative stuff. And then the division director would say, the director of research would say, the quantitative stuff is great, but I'm calling up the head of GM to talk about what's really going on out there or whatever. So here are three heads of GM. So we're calling them up. So, ladies and gentlemen, please, we've got a macro forecast. We've got a California forecast. We've got a set of environmental factors. Tell us how you interpret what's been said here this morning. You can talk to us about other salient, systematic factors that you think have to be taken account of. And John, in the case of owner-occupied for sale, single family, it might have to do with location trends. It might have to do with consumer confidence or consumer surveys. It may have to do with whatever factors you want to bring, and Tara and Ken as well. But firstly, put some meat on the bone, interpret the very dry but very meaningful macro forecast that's been presented this morning. Give us a little flavor.
Sure. What we're seeing is very consistent with what was presented here today. Certainly strong demand in the for sale product with very, very limited supply. And it's certainly driven by the higher interest rates in the new home sector, new home sales sector. Our largest competitor is the resale market. Not our other friendly competitors within the industry. It's the resale housing. So with that sector diminished in terms of supply, certainly the demand for new homes is very, very strong. With the pandemic, what we saw was kind of we've got a challenge here, right? We've got very strong starts that have occurred, which really brought forward a land pipeline of entitled lots much quicker than we had anticipated, the industry had anticipated. So what we're seeing today is very limited supply of entitled lots in a lot of the markets. So the land side is very challenging, very difficult today. Certainly in California to bring and our friend that does the entitlements. It's a challenging environment to bring lots to the market. We just closed on a piece of property earlier this week, 10 years to get through the entitlement process. the owner. Certainly had performance much less, 3 to 4 years, but it took him 10 years. So that's extremely challenging. June is National Homeownership Month, and a recent field survey was done by the Harris Poll, and I think there's some really good, interesting data that I'd like to pull from that and share with you. So of those surveyed, 83% believe home ownership is still an essential life milestone. So the American dream is still very much alive, of the American dream of home ownership. So that's 4 in 5 people believe that. 40% of those surveyed think about buying a home at least once a week. That's incredible. If you break it down into the different generations, so Gen Zers, 62% think about buying a home at least once a week. Millennials, 55%, which is, I found absolutely remarkable. Those surveyed, 58% stated that they would cut back on non-essential spending to save up for a home. 45% have considered and would consider taking on additional income streams, second job, to pay for a home. Primary reasons for owning a home at 49%, which was the highest, was privacy. And we certainly saw that during the pandemic. I think there was a dynamic shift about the importance of where you live during the pandemic. When you're confined to a space, you really start to think about that space and how you use it. Just even the ability to go out into a yard space, enjoy sunshine, throw a ball around. So certainly that aligns with what we saw during the pandemic. 44% view it as a long-term financial investment. When you think about excitement, and they termed it under good vibes, 51% said they're excited to buy a home. 43% said it makes them feel proud to buy a home. And then 32% said it made them feel like a motivated person to go out and buy a home. This was a very interesting number. 56% of those surveyed felt like they were in a worse position to buy a home today than in any prior generations that they're aware of. 85% are nervous about buying a money pit. So that's why you buy new, right? You get the warranty, you get a nice new fresh home. 75%, which is a staggering number, are nervous about affordability, nervous about finding the right home, and nervous about finding the right partner to buy that home with. 1 in 3 believe that they have a solid understanding of how to buy a home financially. So how mortgages work, down payments. So that's a very low number that we certainly at KB Home are trying to lead the charge in terms of education about what it takes to buy a home. Another interesting fact is 54% believe that interest rates are at all-time highs. So that's a perception, not necessarily reality. And that's certainly something that our sector needs to help educate and overcome. As you saw the charts today, we're certainly not at the highest levels. Certainly 1981 at greater than 18% interest rates. So, at 6-7% mortgages, I think we've kind of fallen into what I'll consider to be the new norm. It was interesting as we marched through almost at every major factor. So if you went from 5 3/4 to 6%, there was a breath at 6%. Then when it busted through 6%, you got to 6 1/4, 6 1/2, 6 3/4, 7%. Again, the market takes a breath and pauses at 7. But very quickly, we saw demand start to come back even at the higher interest rates. And people accepted those higher interest rates. Now, we've certainly, as an industry, have had to face those challenges of affordability. We very much are involved in our, as a manufacturer of housing, looking at every component that drives cost. And a lot of it, of our efforts have been focused on our own product and the efficiency with which it builds, so we can continue to bring affordable housing to the marketplace.
Thank you. Thank you, John. Taryn, please.
Sure. So I can talk a little bit about a completely different segment of the market, which is affordable housing. So Community Corp is a nonprofit that builds and operates affordable housing. We've been around 42 years. We have over 2,000 affordable homes that are up and operating primarily in Santa Monica, about 95 properties, and we're now building on the west side of LA as well. So first, I thought I'd share with you a little bit about sort of the market forces at play for affordable housing, challenges and opportunities. I guess I'll start with the entitlement thing, because that kind of stuck in my mind about what you're going through, and I'm sorry to hear it. Certainly one of, I think, the opportunities, maybe to start on a positive note, is that there has been so much support in recent years for affordable housing to get produced, and certainly a lot of government goodwill to try to help speed up entitlements for us. So now we have, I mean, a myriad of different streamlining options, both statewide bills that have passed in the last, say, 5 years or so to allow more density, certainly some recent ones to allow more by right approval processes in city of LA. Of course, there's ED1, which we are very happy about. I don't know if everybody is necessarily. That's still kind of a little ongoing discussion, I think, out there, but certainly, and then there's SB4, SB 423, which will go into effect at the beginning of next year. So those are really positive things, because one of the market forces, or the kind of external forces for us, is time. So we are, as a nonprofit developer, competing on the market for exactly the same types of properties everybody else is. And certainly there's no discounts, just because we're a nonprofit or we're building affordable housing. So we're paying top dollar for land. And typically we're competing, so that means we have to buy it before we have our entitlements and our funding in place. And we carry it typically 3 to 5 years. So I mean, that is a lot. Certainly not as bad as 10 years, although I've seen in the history of our industry 10-year projects as well, which is a real drag. So I would say, starting on that positive note, things are looking pretty good in terms of the entitlement processes. What's really bad is the funding landscape. So first of all, we rely almost entirely on government funding to produce our housing on the construction side. And you all have heard in the news the bleak, outlook for the state budget. A lot of our funding comes from the state of California through the low-income housing tax credit program, through the multi-housing program, which is a state program to provide capital to construct our buildings. And then we usually have to layer our funding. So there's not one source that will just give us our $40 or $50 million we need to build our buildings and go ahead and get started. It's typically a 3-year process just to layer the funding. So we might apply for City of LA Housing Trust Fund dollars, or hopefully now ULA money. Then it will be also the state, maybe the county, maybe some Section 8 vouchers, maybe some tax credits. So it becomes this lasagna that takes 3 to 5 years to create, and then you get to eat it maybe in another 2 years. So it's kind of a strange system that's really been difficult, but it is the system we have that has produced affordable housing. So when certain funding sources go away, that's a real problem for us. So, we as nonprofits rely on developer fees. That's how we pay our overhead and our salaries to keep our operations going. So, for example, the City of LA has pushed back their funding cycle for a whole year, from last year to this year. And now this year it was supposed to be spring. Now it's going to be fall. That all means all of our developer fees are also pushed back. And then it also affects the other funding sources we're going to apply for. So time has not been our friend lately. Interest rates are also problematic for us. It's sort of a different set of dynamics, certainly, than market rate development. But we also get construction loans, and even though they're below market, they're still higher interest rates, and that affects the project costs. as well as our permanent mortgages. So increasingly, because there's less government subsidy locally, we have to get bigger bank loans at the end of the day, our perm loans. And the higher the interest rates, obviously, the lower the cash flow. It becomes a math problem because our rents are low and they can't go up. Say, if, oh, now the interest rates are high, we can just raise the rents. That's not how it works for us. Our rents are fixed. Then, let's bring into the mix the insurance situation that was just discussed before. So we're certainly not immune to any of that. So we have a portfolio, like I said, of 95 buildings, and our insurance premiums went up just this year, $3 million. So, I mean, we're a nonprofit, where's that money going to come from? Well, the good news is we have reserves in each of our buildings. We set aside money for capital replacements. Great, except now we're using all that money to pay for insurance, which means long-term, this is a really bad thing that's happening for us because now we're going to have less money for roof replacements and other things we need to do. So I would kind of echo what was said about it's a really challenging environment. So, I think we can discuss more, maybe some possible solutions. Certainly, we've been trying to figure out how do we get away from our reliance on government funding. But, when I hear what other people talk about, it's like, well, it's not really that much easier on the traditional capital side. I've certainly tried to have lots of conversations with investors to see if there's any interest or appetite in lower rates of return. So, given that our rents are low, are there sort of B Corps or other impact capital groups that might be willing to take a smaller return and we could use investment type dollars instead? So far, I haven't found anybody. So if anyone knows, please do let me know. So that's kind of the set of landscape we've got going.
Thank you, Tara. Ken,
Mhm.
please.
So two preliminary comments. I used to be 6 feet tall. And I am now a dinosaur. Multifamily, we didn't really touch on multifamily starts in California. And I don't know what that statistic looks like, but I can tell you it looks like next to nothing for units that are above 100 units or more. We've talked about all of the factors, including interest rates and NIMBYs, et cetera. We talked about construction costs earlier. What wasn't discussed in the construction costs everyone should be aware of is we talked about construction labor and material. But the factor that we didn't discuss is, and one needs to pay attention to, is construction spreads, meaning a subcontractor who does drywall could either put a margin on his profit margin of 0 or 40%, depending on supply and demand. Right now, it's true that multifamily hasn't started at all and won't start for the next couple of years at least, but the single family guys are picking up the slack. So that's the beginning of what I want to say, and it's not going to get any better, because what we didn't talk about are two significant issues that relate to multifamily, and that has to do with two referendums that are happening in November. One is called the Justice for Renters Act, I believe. Some people call it the Weinstein Initiative. And it is an initiative that would roll back Costa-Hawkins. And Costa-Hawkins is a law that basically locks in certain kinds of rent control in many cities. By eliminating the Costa-Hawkins rules, it would allow cities to adopt whatever rent control they want. So that, as an example, in the city of Los Angeles, rent control effectively terminates or does not apply to buildings built after 1978. If Costa-Hawkins is removed, the city of LA will undoubtedly add to the rental control restrictions to newer buildings. They may even apply to brand new buildings. That will put a complete kibosh on new construction. That's the first problem. The second is the Taxpayer Protection Act, which some people know as the law that will impact or try to overturn what is called the ULA in Los Angeles or the mansion tax. And that issue is a significant one for cities across California. If it doesn't overturn, if it's not overturned, what you'll see is every city will start to implement something similar to a mansion tax. And to give you a great example of what the mansion tax looks like, imagine someone who bought a building for $20 million, and per our discussions earlier, that building is now worth $15 million. On top of that, they still have to pay, even though they lost $5 million, they still have to pay a mansion tax of 5.5%, whatever that is. It's $900,000. It's a gross sales tax. It's not a profits tax. So that's another significant issue that is going to implement housing and multifamily starts. So the last thing I want to say is something that we didn't talk about at all, and that is the Great Reset, what I consider the Great Reset. If you know what a cash and refinance is, when we're talking about that $20 million building, it had on it a loan at the time of $15 million. Well, guess what? The lenders, when that loan comes due, and then a lot of them are coming due now and in the next year or two, that the lenders will say, we're happy to make you a loan, but instead of $15 million, we'll give you 10. Well, the developer is going to say, I don't have the money. So what we're not discussing and how it impacts financial institutions and the housing market and new starts is where's that $5 million of additional dollars going to come in to pay down that lender? More likely than not, you'll see a lot of foreclosures or you'll see a lot of workouts, but you won't see a lot of new construction.
That's very cheerful. Luckily, we're getting close to lunch, so the roof will come quickly.
So here's one thing I do want to say. And
Yeah.
that is because there are no starts, it is true. And because prices of homes are so high, the people who have existing apartments who don't have large debt will see increases in rents starting next year and for the foreseeable future.
Well, okay, so I'm going to add one factoid because it is so cheerful. And then I'm going to go back to the panels one more time and for very quick remarks, okay, the second round. And then we're going to open to all of you, but actually we're getting close to the witching hour here, so we'll have to do this all quickly. The factoid that I want to add is that we did a study here at UCLA recently on behalf of the mayor's office, where we took a look at the local approvals process that relates to the production of multifamily housing, and in particular, affordable multifamily housing. And one of the salient findings of that study is that the approvals process alone, before you even start construction, can take upwards to 3.5 years, number one. And number two, it takes 5 years from the first building permit pulled until you get a certificate of occupancy on average. So if you're imagining we have a housing shortage here, and if you're imagining that we need new affordable multifamily product created, I mean, again, what is the most basic response to a housing shortage? Create new supply. That's what we're talking about. Well, what our study said is it's going to take, starting today, 5 years to get a key to that unit if the building permit's issued today. And so this is a very tough situation that the mayor is working on. We were able to show statistically how both the length of the approvals as well as the uncertainty related to the approvals have a statistically and economically significant depressive effect on new construction. So I just wanted to add that cheerful little footnote to what Ken said. But okay, for the panelists, very quickly, give us one or two of your best shots. In other words, tell us something that's good or something that's bad or something that keeps you up at night. Tell us something we don't know about your sector that is going to be of serious take-home value from this event.
Well, I mean, if you, what I want you to remember walking out of here is, single family housing for sale is, vibrant right now. Like in my opening remarks, certainly strong demand despite the affordability challenges. You know, on the difficult, challenging side, certainly entitlements. If I look at the greatest opportunity to solve a lot of these issues that we're faced with, and it was said earlier, we need more housing, certainly streamlining entitlements on any front, whether it be multifamily, single-family detached. You know, many of these municipalities that we deal with are severely understaffed. Very similar to, you know, our trade base. I'll try to wrap this up quick. Very similar to our trade base. You had almost 7-8 years where people didn't really want to get into the industry, right? From 2008 to kind of the false start of 2014. So you had, you know, very strong 7-8 years where people just didn't think about the housing industry and sector. And we see it even within our company today. When you look through our management structure, you just see a great gap of people and knowledge. Now I'm happy to report that with you know, very strong construction management programs that we certainly have here in Southern California, we're quickly filling that pipeline. And we spend a tremendous amount of time mentoring and teaching our own employees. So you know, there's definitely a gap there though of people with strong knowledge of the industry that is much needed, not only in the municipal side, but certainly the private sector side.
Great.
Sure. I guess I'll just say a few things. So first of all, I think we also have a lot of positive aspects about what's happening in affordable housing industry. Like I mentioned earlier, there's a lot more political will than there ever has been. So I'm really happy to see Mayor Bass and her team really working hard to try to get real streamlining measures done, and not just in the planning department, but also LADWP. Hooray. So, you know, a lot of good things happening. Also, a lot of young people have gotten much more interested in this topic. That's why I always love coming to UCLA, because UCLA does a lot of programs to teach young people about affordable housing as a career. And a lot of people are interested in it, which we need, you know, all the good minds in this work, because you know, we're not going anywhere anytime soon. Unfortunately, we're not going to be able to solve, you know, the low income and, you know, the income inequity issue or the homelessness issue. So we need more people in this industry. And as well as I've also seen a lot more neighborhood support. So not only young people, people like LA Forward, activists, but, you know, people in the neighborhood who say, you know, we're okay with our neighborhoods being more diverse and more inclusive. In fact, we want that. So I'm really excited to see that. You know, on the supply side, one thing about our industry is we are always quite stable. You know, our supply is through the roof. Our supply is never going to meet the demand. Unfortunately, we have, for example, last year we opened a building in Mar Vista and we had 50 apartments and we had 6,000 people apply. So, you know, it's not a great statistic in terms of that's how bad the need is, but also I know that we have a lot of good work ahead of us to really try to meet the demand.
Okay. There's a lot of positive things happening legislatively that might turn my dinosaur market rate hat into something that's a hybrid with affordable housing. ED1 is an example. It's a market rate program. You're seeing some things happening at the state level with even with CEQA or other affordable housing type of mechanisms, just to free up the market rate developers so that they can go into places in other cities where before, if it was a commercially zoned property, you couldn't do anything with it. Now, even if the city doesn't have that zoning, the state has effectively created that zoning. So you will see more supply. It's just going to take time.
Mm-hmm.
Very good. So that truly is a bit more cheerful. Okay, so this is your chance. You've been really very attentive for a very long time. Now it's your chance to you know, Jerry's here, and you know, the whole forecast team is here. The two Davids are here, panel's here. Please raise your hand and ask the most controversial, difficult question you can muster. David, I don't know if you get to ask a question. Let's just other people first. You had a yeah, I see a question there and a question here. David, you'll be third. Yes, sir.
Talk about the two ends of the spectrum in housing affordability. We talked about employment at the beginning in the various industry sectors. Now we're talking about the supply of housing. Where do you see the two jaws of the pincers coming together? Because if housing prices are going to stay very high for rents and mortgages, what about in Southern California, the ability of people to pay those rents and mortgages with good, stable jobs?
So we're seeing a lot of multi-generational families coming together to purchase a home. Grandparents, children, grandchildren, multiple incomes to afford the home. So, you know, I think the market tends to find ways to solve the problem itself. But I would say from our industry, we're pulling every lever, as I mentioned earlier, to try to pull every ounce of cost we can. Certainly some of the largest factors, obviously, is just the raw land, what we have to pay for the dirt. That is still on an upward trend. We're starting to see a leveling on cost. It's not quite there, but we're starting to see it level both vertical and horizontal cost. So those are positive signs certainly within our industry.
I mean, I guess I'll just say, I think we do need to pay more attention to the housing and workforce kind of nexus. Certainly at Community Corp, we're trying to figure out how do we provide support to small businesses in an affordable way. So we are actually tomorrow opening our first small business incubator. So the idea is, you know, not only should your housing be affordable, but we need to help, everyone needs to help try to figure out how to get more well-paying jobs so people can also, you know, be sustainable economically and maybe not then need affordable housing.
So my only comment would be with respect to affordability in Southern California, obviously it doesn't exist and it's not going to get better unless there's some kind of governmental intervention. And I don't just mean for 50 or 80% of AMI. The missing middle is really critical. Sacramento has ignored it. I think that there is now a push for 120 to 140% of AMI as a focus. And I think that's where we should be looking to push our legislators.
Yeah, I agree on that.
And I would just add a couple of things. One is to take the KB Home example. It's extremely difficult for KB to implement their business model anywhere in coastal California. So the implementation of the business model is in the Central Valley, it's in the Inland Empire, it's in Phoenix, it's in Tucson, it's in Texas, it's in Florida, it's in the Pacific Northwest, et cetera. So one of the statements that was made by this David, I think, and maybe that David, and maybe Jerry, is that you're seeing different locational dynamics, different work, office participation dynamics post-COVID. So if you think of the pre-COVID and post-COVID, the suburbs have come alive, ex-urbias come alive, new locations across the United States have come alive. So people are searching for ways to find that affordability, and bear in mind that affordability begins with the cost of land. And that cost of land, of course, is impacted by interest rates and other factors as well, all the usual economic fundamentals. But that cost of land is not at any point in time expected to be affordable in coastal California. I would add that. I think we have two questions over here.
Just a couple of questions. One of the things that we haven't talked about is during the COVID time, there were a lot of rental provisions, protections that didn't allow evictions. Now that time has passed and the accounts receivable in the books have actually swelled. There's been a lot of evictions on the rise that's been clogging the courts. How is that going to impact? Any thoughts on that? And the second question, I was asking David this earlier, the baby boomers, as they age and there's a transfer of wealth, including homes, down to the lower generations. Is there any thoughts on that, on the impact of, how does that impact the housing ownership?
I think you were looking at me when you said aging baby boomers. But anyway, who wants to take that question?
Well, with respect to your first question, that bad debt will be written off. I mean, our company, every company, multifamily developer I know that's been in California has had a significant amount of bad debt. They are never going to collect, and they're just writing it off. And it's past tense, as far as they're concerned, everyone's looking forward.
We're kind of in that same boat, although we are trying to get our residents to get on payment plans, even if it's only some kind of small amount per year, per month, but just to help feel a little bit of ownership on their end. But yeah, our goal is not to evict, that we are considering writing most of it off. So it's unfortunate, but looking ahead.
And I'm gonna call on David Schulman both to answer the question and to ask his
I
question.
just want to, I just want to ask a question.
Okay.
It's for Tara. How is it sustainable to deliver affordable housing in Santa Monica, West Los Angeles, at call it $800,000 a unit? How is that really sustainable? Why should the government subsidize that type of activity at that cost when KB can deliver a house $450 in Inland Empire, 500,
Median's now up to just over 600.
600? All right. But it can deliver. How is that sustainable at that kind of a cost? And why should the government be even thinking about doing that? Because how many houses can you really, how much housing can you really provide at that cost structure?
Yeah, no, I definitely understand the consternation about the high costs. You know, unless the government intervenes and helps lower the cost of construction or of land or anything, I don't see that changing. We do have a sustainable model, and typically that's because we have economies of scale, and certainly all of the provisions and initiatives that have increased density do help bring our costs down. So if we can spread fixed costs on a greater amount of apartments, that certainly is good in terms of reducing costs. So, you know, building a 4-story building instead of 3 if your land cost is fixed, right? Why should the government subsidize it? Well, certainly I believe that every community should have affordable housing. There shouldn't be communities that are exclusionary to any one person. That we need to desegregate our areas here in LA and provide housing at all different income levels. But that's my personal perspective.
But then why does the government enforce project labor agreements, which raises the cost of housing?
The government doesn't do that. The labor unions are the ones that are asking for that and pressuring the state to agree to that. And, you know, certainly as an industry, we've done a lot of work with the labor trades and we don't always agree, but I will say it's counterintuitive to say, you know, give us all this money, but we don't want to pay people a living wage. So we have a lot of heartburn with speaking out against, you know, paying prevailing wages. Project labor agreements are tough. They do add cost, but that's a little bit outside of what we're able to, you know, influence.
If I can interject on that one last comment, wait a few years, you're going to see modular housing tremendously impact the affordable housing industry.
Yeah, I
Great,
hope
great,
so.
great. Okay, we have time for, or maybe we don't, but we'll take one final question, and it's got to be who's got the final? Oh, yes, ma'am.
So, going into the idea of strategy and speaking of like positive deviance, is there a location that's getting it right? Or is there an industry maybe that isn't real estate that has a similar concept that has done it successfully to where we can be looking at how to move forward? And do any of you have a completely out of the box thought for something that could be done in the industry?
The only thing I mentioned was, I think that modular housing and technology changes. I was in Pompeii 20 years ago. I saw construction that occurred in, I think, 300 or 400 AD. We're still building houses exactly the same way as we did almost 2,000 years ago. That has to change. It will change. If you go to Europe, you'll see the changes. They've happened already. Modular housing, high-rise modular housing, things will change. That's our best way out.
Yeah, and certainly there's been a lot of focus on looking at housing models in Europe, such as in Vienna. I also went to Helsinki to look at some of the social housing there. I mean, I think there's some interesting things that we can take away from them. Particularly, I think shared housing could be really interesting. I saw a lot of units there that had, say, a 4-bedroom house and one person in each bedroom with a shared kitchen and living room. So I think we should start looking at some more of those ideas and seeing how those can translate.
Yeah, I mean, I'd say from the traditional stick frame build side, there's been we study construction science every day. We look for innovation every day. 25 years ago, everything was hand framed and cut in the field. Today, everything is manufactured. All of our walls are manufactured at a facility and brought to the site already assembled. Used to be conventionally stacked roofs. Now everything is a roof truss system. So there's evolutions coming, not quite to the level that you see maybe in some European countries that he's talking about, but we constantly look to evolve to stay current. So, and that's part of pulling the costs out of every component. Those evolutions are being driven by affordability. So, at the point at which the market rejects your housing because they can't afford it, you continue to evolve your product, and that's what's occurring today. We're constantly striving to build a better house today, more efficient house today. We look at cost of total home ownership, so the energy efficiency of the home, the water. Here in California, you have WaterSense, WaterWise. So the total cost of home ownership, not just your mortgage. So what does it cost to operate the entire home is studied.
Excellent. Ladies and gentlemen, please join me in thanking our panel.
Nice to meet you.
Thank this young man. He works really hard all the time.
Yes.
Yeah, nice to meet you.
My first job was at Crazy.
Oh, really?
Housing division.
Demand. So before you leave, just a couple of announcements, but one thing that I want to add to what this great panel was talking about, the price of land is important. And as a transportation economist, one thing I know is you can add land to cities if you view transportation and efficient transportation as housing policy. So before you leave, I want to recognize our sponsors once again. We couldn't do these programs without them. So quickly, but please bear with us because this is important for us. Our principal sponsors are RSM and Yamava Resort and Casino at San Manuel. Our platinum sponsors, the law firm of Allen Matkins, California Bank and Trust, Cathay Bank, Clark Construction, Leap Development, and University Credit Union. Our gold level, Avenue Insights and Analytics, California Steel Industries, Hub International, PNC Bank, Robert Half, and United Airlines. At the silver level, Bank of California, Chevron, Commercio Wealth Management, JLL, Marsh McClellan Agency, MBK Real Estate Companies, and SMBC Manubank. And also at the silver level, US Bank, Private Wealth Management, and Wilmington Trust. At the bronze level, Hanmi Bank, HDR, McCarthy Cook, PCL Construction, Shawmoot Design and Construction, Shopoff Realty Investments. At the Bruin level, Advisors Real Estate Asset Services, Gerber Kawasaki Wealth and Investment Management, and Shell Energy. Thank you so much to our sponsors. Thank you all for coming, and all of you who are virtual, those who are in person, safe drive home, and for all of you, have a wonderful rest of your day. Thank you.